dear students, with the requisite knowledge to be able to put up a quality research report and also to help bridge the gap between industry and academia. So today we have, very experienced industry professionals who would walk you through the intricacies of putting up a very, good research challenge. The first session today will cover industry analysis. And Daniel, who is a research analyst at Blackstar Group, will take, the time and walk you through, that. After Daniel's session, Julius, our valuation and financial analysis expert, will walk you through how to conduct, mining, valuation, at least the basic. You're supposed to build upon what you learned today to be able to value the subject company of the research you'll be dealing with. And in the third session, Michael, who was a resource during last year's bootcamp, an MBA candidate at MIT, past research analyst at Blackstar Group, would also walk you through how to put together a good research report. So basically, he will touch on report writing and financial statement analysis. You would have, so much time to ask your question. I would encourage you to pay, rapt attention to what you'll be doing today and ask questions if you have any questions, to ask. At this moment, I will hand over to Daniel Tete, research analyst at Blaster Group, to briefly introduce himself and then start the session. So thank you very much.
Hi, thank you very much, Mr. Nanari Afibuama. Thank you to the CFA Society Ghana, and thank you to IKEA for giving me this opportunity. I'm trying to share my screen, and then we'll go on with that. Yeah, hi IKEA. These are just requested for access to share screen. If you could assist with that.
Yes, you're good to go.
Yeah, awesome. Can you please confirm which screen you're seeing?
Business analysis, equity research, bootcamp.
Okay, cool. Thank you very much. Like I said, it's a huge opportunity. Am I supposed to share my video? Yeah, I think that works. Hi, can I be seen?
Yes, you can.
Okay, awesome. Yeah, so just a little bit of background. I'm a COVID graduate from the University of Ghana, read finance, economics, and math at the University of Ghana. And then I went into industry to, I did my 1-year service with a beauty brand, L'Oreal West Africa, one of the largest beauty brands in the world. There, I think I fell in love with supply chain. I was doing a little bit of marketing as well and a little bit of sales. So I had time to I mean, go down grassroots and sometimes Mokola, see what the distributors that are actually moving the products, etc. So yeah, my time there was pretty much of a good experience. I think I picked a lot of love for finance, supply chain, etc. Then after that, I went out to into project management. I did 8 months with KVK's Resources. Was a startup that was helping other startups. So financial assistant to personal assistant to the director. Um, Around that time, I think I was managing about 2 farms at the time, a poultry farm all the way in Dowinya, Community 25, and another business somewhere around the same environment. And I think it's there that you come to terms with most of the things that you learn in school, how you have to explain um, some of the numbers to the higher ups, help convince them on whether the business is viable or whether it is not. So yeah, that was my time there. Then I moved to Blackstar, where I'm with the sell side, most importantly, the brokerage side, where we do sell side research, try and pique investor interest in securities that we trade in, just to get our volumes up and make a little bit of revenue. So yeah, it's very good to be on this call with the likes of Julius, Senior Julius. I was on his 3-day financial modeling class this year, where he was giving a little bit of, not a little bit, a lot of insights on financial modeling. Good videos. They're on YouTube. I think you should check them out. Definitely. And like Mr. Nana Boama mentioned as well, Michael Akpau, he was one of the founding fathers of the Black Star research team. So a lot of respect to him and every other industry player who is on the call at this point in time. So yeah, I've been advised not to spoon feed you. So I'll try and be a little bit more measured um, with some of the things that I share, just to give you people space to be creative, yeah, and to find niche areas that other people may not be able to uncover because it's a competition. But then again, I'll share most of the things that you would need to know, so that there's a level playing field for everybody, and so that you all can come up with the best research work that you can possibly put out. So yeah, I'll jump right straight into it. So, in analyzing a business, there's so many places that you can start really. Uh, I was never a numbers person, so I never really like starting from the financial statement, because it doesn't give you a true picture. It gives you a picture, but it doesn't give you a holistic picture of what the business really is, what really drives it. So, because of my bias or my bias away from numbers, I found a niche area for myself where, over time, I carved out, and then I tried to hone my skills. And so I usually don't advise that you start with numbers, especially if you are not a numbers person. So where you start your financial analysis, or where you start your analysis of a business, really matters. And I prefer to put it in like about 2 parts. So the first part, where you call the what is the business really into, right? You need to understand what the business really is into. Do they sell chocolates? Do they sell cigarettes? Do they sell chewing gum? Are they into pharmaceuticals? Like, what does the business really sell, right? Or what's the business really into? So that's one part of your research work. Your research work is supposed to, and it's supposed to tackle this first part. What is the business really into? Then the next part of your research is really to tackle, what does the future really look like for the company? Because the main idea of when you're trying to pitch to the panel, or to the board of trustees, or to an investor, is, this is what the company is today, and these are the prospects. Because of that, I want you to invest X amount in X. You get it? So you need to first, I break it down into 2 parts. So first, you need to know what the business is into, and what does the future look like for the company. So under what you are looking at for what the business really is into, what problem is the business solving, right? You look at the likes of Uber. the kind of problems it's solving on our markets when you juxtapose them to the taxi system that we have. So at dawn, you don't have to move from your home to a particular junction where you know there's usually that's the usual route for a taxi to come meet you and then go to the destination that you want to. That's the problem that Uber is solving. So you look at the likes of Glovo, you look at the likes of Golden Tree Chocolates, you look at there are so many other companies that you can mention and then try and drill down into what kind of problem are they really solving. So when you look at a business, you look at what they sell, you look at, okay, what problem are they really solving? And from that, you get like a top line view of what the business really is about. So what do they sell? And what really is their business model, right? So you look at the likes of Apple. Okay, it makes Apple phones. What else does it add? You realize that when your Apple phone comes, it comes with it comes with your Apple Music, right? So even though they make phones, they've also found another area within that production line where people have to, on a monthly basis, subscribe to Apple Music. So in that line of business, they have other chains that they use in generating revenue. So when you look at a business in these two, let's say, top line ways, you need to look at, okay, what's their business model? What are they trying to achieve? Okay, when they issue out the product, okay, Microsoft is into they manufacture laptops, etc. Okay, they put them together. They are also into software introduction into I mean technology, etc. Okay, ad revenue. Okay, you need to look at it broadly, right? You look at what problem they are solving and what even goes into the product, right? And what is their business model? How do they make money, right? And then you look at where their location is really matters. It's one of the major topics that they speak about when you go through marketing in university or any other area where your location really matters. I'll give you a classical example. Um, Apple, right? So I use Apple a lot today, but I'll try and mix it up with other companies. So Apple is sort of a US company, but most of its assembly is done in China, right? When you look at a company, you fail to look at what their location is, right? You have a situation that you have now that the US and China are in sort of a turf war in the AI space, in trade, etc. If China should place sanctions on the way Apple does business in China, what is the effects going to be? So when you look at a company, you need to look at where it is located, where it does business, right? If there are going to be problems in China, okay, what is Apple doing to solve that problem, right? Okay, Apple has realized there's a problem in China. And what are they doing? They are setting up plants or they are setting up manufacturing areas in, let's say, India, right? How fast are they doing that? Okay, what is India's population? You get it. So it's a series of questions that you need to ask yourself. And those series of questions, as you go through your business analysis, you by answering each and every single one of them, you get closer to a much more concise ending to what your view during that analysis process comes to. So you're either building a very strong opinion about the buy, or you're building a very strong opinion about the sell, or a strong opinion about the hold. So you need to look at what the business is selling, what their business model is. Okay, how does it make money? Where are they located? Where do they manufacture their products? Who's their competition? Who's really their competition? You need to know who their competition is. And aside that, you need to look at, okay, what does the future look like for this company? What is even their business strategy, right? So you look at their business strategy, you look at, okay, is the business viable for the future, right? So if let's say you go into the automobile industry, we are in a part of an era where the world is moving away from internal combustion engines and we're heading into electric vehicle area. Okay, so if you're analyzing a company like say Ford, right? What is Ford doing in being a part of this transition, right? In being a part of this fourth industrial revolution. So is it in a good position to battle the likes of BYD, battle the likes of Tesla in that industry. So what is their plan? How do they intend to get ahead? So in picking them and looking at them broadly from these two sort of lenses, you are able to build a top line view of what the company is about and where it intends to go and how it intends to get ahead, right? So, and then if their cash flow is even sustainable, right? So by doing all of these top line, I'm just breaking them down into two. After we'll go deeper into each section, and we might even have other sections that give throw a bit more light into some of these areas. So yeah, you look at what the business is into, and then you look at what does the future really look like for that company. So how do you really start this? I've said a lot of things, and sometimes it's good to make it a bit more practical. You need to read through their website, right? You can't analyze a company without reading through their website. It sounds very trivial, but you need to pay attention to what the company says about itself, right? What does the company really say about itself? How does it describe itself? Um, what is the journey like for that company? What has the journey been like? You look at companies that have been started from single rooms to multinationals, and that's a good story to tell. That's a story that an investor would want to hear to hear. That's a story that a trustee would want to hear. Understanding the journey of the company is a very big plus. It adds to the passion that you add when you are talking about the company, right? Because you know that, okay, this company was started this way. It went through some challenges around this period, but it went into a merger with so and so and so and so. And now, because of some of the innovative research that they came into contact with, or some of the innovations that they had in their business, this is where they have been able to get up to. If you are analyzing a company and you want to leave out the sort of the DNA or the culture of that company, then your research work becomes a little bit flawed because you don't really understand what the journey of the company has been, and you wouldn't be able to really appreciate where it is headed, right? So you read through their websites, you look at the journey of the company. And personally, I watch a lot of YouTube videos. I'm trying to make it a lot more practical. You need to watch a lot of YouTube videos to know which other companies are in that industry. Okay, what are the other people doing in this industry? Are they coming up with self-driving cars? Okay, are we moving to a part where cars are becoming invisible? Are we moving to a part where you people are building in extra components into electric vehicles where accident rates are reduced? Like, what are they doing? And by juxtaposing and watching a lot of material and a lot of reading, you begin to, for yourself, build an opinion of what the company is. You also have a clear view of what other competitors are doing, maybe not in Africa, maybe not in sub-Saharan Africa, maybe in Asia, maybe in South America, maybe in North America, maybe in Europe, right? So you watch a lot of YouTube videos, you find similar companies that would help you find clarity, right? And sometimes if the company is listed, you need to read their prospectus because that is what they are really selling. That's what they are really selling about themselves, right? So, for instance, if you go through the Asante Gold prospectus, in the first line of how they explain what their business is, you should be able to know what their business is, right? The first thing they say is acquisition. So you should, you read meaning into that and you know that, okay, this is the kind of model or this is the kind of business that it stands for. This is what it sees itself to be, right? So you read a lot of its prospectus if it's a company that's already IPO'd or already listed. You need to go through that. If it's not listed, you need to go through their website. You need to find other research reports, and you need to find news about them, right? Imagine you do a very lengthy evaluation on a particular company. You've done all your analysis, and you head into a meeting, try and pitch the idea to someone, and then the board says that, have you heard that so and so company has been fined 35 billion US dollars for so and so and so, and you have no idea about it? You need to also, together with everything that you are doing that is quantitative, you need to build also a qualitative base of what the company's name has been in the news, right? So what has been said about the company, what is happening, what is going on. This helps you to sort of rebut and sort of explain further. It gives you like it's like a shield for you for some of these meetings that you're going on, some of these panel discussions that you guys will be engaged in, right? So, what are some of the key events that have occurred within the company? And in other sections, I'll try and explain because some of the events that you might have cataloged, right, whilst looking at the company, you would see that it would have similar trends with some of the patterns that will be drawn from the financial statement, which Senior Michael Akparo would look at. It would also play a role in some of the valuation basics that Senior Julius will be also discussing. So you need to look at events. You need to get a catalog of events. What has their performance really been? You need to check the website. Sometimes they give you fact sheets on what they've done. Sometimes it's not just a company in Ghana. Maybe it's a company that's all across the African continent. Maybe it has subsidiaries like in other places in the world, etc. Now, the other thing that you need to know is in analyzing and understanding the company, you need to know who their customer is, right? There are brands that are targeting the higher end individual, right? And there are brands and companies that are targeting the lower end. And there are companies that are targeting just toddlers. There are companies that are targeting just people in the older generation, right? So you need to understand who their customer really is. And one of the most important things that you also need to know is you need to know who their board members are, right? And the reason why it's very important is because these are the minds that are driving the company, right? These are the minds that are driving. You need to know what their experience is. So you look through a company's websites and then you see, okay, Paulo Ramela, 22 years plus in financial analysis, in fundraising, valuation, mergers and acquisitions. Okay, graduates, REMS Management School, firms. Okay, foreign trade advisor to the French government at a point in time. Okay, that's solid. We can work with that. Okay, Nia Mankratete. Okay, 20 years plus in regional financial services. Okay, he's coming into the role from executive directorship, UMB. Okay, country CEO at a point in time to Bayport, Ghana. Okay, we can work with that. Former employers, APSA, Standard Chartered. Okay, that's very good. So you build a sense of okay, what is management like? What views have they purported in the past? And this doesn't just apply with Ghanaian companies, it applies to every single company that you look at. And with every single thing that I say, I want you to look at it from the lens of the companies that you guys are trying to um, analyze, right? So look at the individuals. Okay, he's in charge of general operations. Okay, what has been his level of experience with operations in itself? Has he been, is this someone who has been picked from the people within the company who have been in operations for a very long time and have further education? Is it somebody who has been picked from, has been pushed from a very large or a competitor? What level of experience does he bring? Some of these things help shape your view on where the company is going, right? So if, for instance, we say Jamie Dimon is stepping down from JP Morgan today, it's going to have effects in the market because people then begin to wonder, okay, who is next in line? Is the person that's next in line fit to run this company to where the company wants to be? So drawing parallels from some of these things are very important. What is the board strategy? By doing all of this, you find out okay what the board strategy is. If a company has board of directors like Carl Ramela, Nia Mankra, you know that there's depth of knowledge on foreign trade. There's depth of knowledge on regional finance. There's depth of knowledge on banking, and there are other areas that you might even be able to unearth, right, as you go along. So it's very important that you find out what the board composition is, what their background is, whether they've been internal, whether they were brought up, they climbed up the ladder, whether they were brought in from other competitors, etc. And what are their internal policies to grow the business, right? What is their ESG policy, etc. I'll come deeper into that in other slides. So then you also need to go deeper and in understanding the business. Who are they partnering with, right? So you have a chocolate company and they've partnered with Tony's Chocolonis, one of the largest chocolate producing companies in the world. What does it do for them? What it does is that it gives them exposure. Their products get onto global markets. Their products leave Ghana. They get onto the European markets, get into Asia, get into South America, get into North America, and all over the world. It gives them exposure. So by doing your business research or by reading or starting to read about the company, you would find out mysteries. That's what I call it. It's partnered with a very huge fashion brand, luxury brand, Louis V. Okay, what does it mean? It means this, it means that, it means there'll be funding, it means they would have exposure, it means they'll be at very higher end fashion runways. Like you see, it gives you an understanding of where the company is headed, right? So you need to do your research very well, read about the company on the website, what news is surrounding the company, what does the company say about itself, who are the board of directors, who are they partnered with, right? Now you've done all your company specific research, right? The company doesn't work in isolation. It works in an industry. So you need to you need to pack that down. So all of the things that you find, you put them together, you put them in a notebook, you put them in a document, you put them in a PowerPoint presentation, you put them down because those are the raw and sometimes refined information that you've got. Now you need to move on to the next level, right? Where you look at industry. Now there are a series of ways that you can do. You can do the top bottom down approach any which way, but this is the approach that I chose. So you need to understand the industry, and by understanding the industry, it starts from knowing who the regulator is. So who regulates the industry? We've had series of times in this country where you didn't know who was regulating who, right? So you need to know who is regulating the industry, right? Who is regulating the? Is it the minerals? Is it the Minerals Commission? Is it Securities and Exchange Commission? Is it the GSC? Is it the NPRA? You need to know who is regulating that industry, and that informs your view on the kind of laws that you think apply to these companies, right? So understand who regulates the company, and what's the story of the industry? What really is the story of the industry? If you're trying to pitch a company in Ghana to a banking company in Ghana to someone in, let's say, Asia, you can't talk about that banking company without giving context to the fact that Ghana's banking system has gone through a crisis within a period. You can't talk about that without talking about the fact that we've had series of IMF reports that have spoken about Ghana's deteriorating capital adequacy ratio in series of years, talking about our non-performing loan ratios, etc. So you need to find out what the story of the industry is, right? If it is energy, if it is agriculture, if it is finance, if it is SME, you need to know what the story of the industry is. And sometimes you won't be able to find all of this information until you look at some of the people that track the industry, right? So you look at industry trackers. So for instance, if let's come to Ghana, if let's say MTN, you want to know what MTN's market share, you need to know who tracks the market, right? So National Communications Authority, they put out a series of reports on who are the leaders in the market. Okay, who is leading in fixed fixed voice, and you know that it's telecell. Okay, data dominations, MTN, voice dominations, MTN. So your industry analysis will review, even to an extent, what the company in itself is focusing on, right? So you might not even see that in your business analysis, but as you go ahead and you go into industry analysis and you see breakdowns, you'll be able to know clearly from the numbers that they put out that, okay, for the past 10 years, telecell has been the leader in fixed voice, right? So that's a niche area that they've carved out for themselves, right? And you see that even though they've taken that part, right? And you see that, okay, this is what AT has taken. You see what MTN has also taken. So by doing your analysis, you'll be able to see what even the company is focusing on when you do your industry analysis, right? And what is the available market research on this company? What research has been put out by independent companies, by brokerage firms, by research firms? What are they saying about the company? And is the industry going to grow? Is it a budding industry? What is the projected growth? You need to ask yourself these questions. You need to write them down. What is the projected growth of this industry? So one of the exhibits that I've shown here is that of McKinsey. They put out a very interesting industry report on lithium mining. So in this report, one of the exhibits is lithium ion battery demand is expected to grow by about 27% annually, reaching about 4,700 gigawatts per hour by 2030. This is industry information that you would need to put in your analysis or need to put at the back of your mind when you're analyzing, let's say, a company that's producing lithium batteries, right? Because this shows you what's the demand growth is going to be. If there's going to be demand growth, then obviously, if there's enough supply, then you are in business, right? So you need to know what the demand is. And sometimes you need to even know where the demand is coming from. So if you are looking at gold, for instance, you need to know how much demand is coming from jewelry, is going into jewelry fabrication, how much demand is coming from the technology area, how much is coming from investments. You even need to know how much central banks are investing in gold, right? Whether there's a shift, you need to look at some of these trends. You see that, okay, there's a de-dollarization conversation. Okay, what is China doing with its treasury bills? Is this selling off treasury bills? Is this trying to stock up in gold reserves? You need to, in your industry analysis, by going to some of these sites like the World Gold Council, by going to McKinsey, by surfing Bloomberg, you'll be able to find S&P Global, etc. You'll be able to find some of these points to be able to beef up your business analysis or your industry analysis. And you also need to look at the innovation in the industry. What's the pace of the innovation? Is it moving very fast? Is it innovation that everybody can benefit from? Is it innovation that is only stuck in one area that one company has monopoly over? Okay, if it has monopoly over it, how does it make sure that it drains the market, or it makes most use out of the kind of monopoly that it has? So your business, your industry analysis, it adds on to your business analysis. It gives you context. So sometimes you realize that when you're doing your research work, you'll be seeing that, okay, this is what the company wants to do. Okay, even when I did my industry analysis, I realized that this is where the industry is also headed. So everything that the business is doing is trying to tap into where the industry is going. Then you know that the company is on the right path, right? Even sometimes in industries, you would realize that there have been this number of mergers, and that's the reason why this company is now a giant in, let's say, the agricultural sector, because it merged with this company in 2006. Then another company came from the US, acquired it, and they started operations in Ghana. They expanded, and so, and now they are industry monsters, right? Providing the best service, producing the best products, etc. And that has put them ahead. So Your industry analysis has to be very in-depth. And you can, for mining, for instance, you can go to the Minerals Commission. Sometimes when you're looking at companies that are outside Ghana, you can look at Edgar, you can look at the Bank of Ghana. If you are researching into a company that's in the financial space, you can look at um, there are lots of companies that you can look at, a lot of regulators that you can look at. Sorry, that would give you enough insights to some of these companies that you may be researching on. And you can do that, you can do your business analysis. But my favorite part of that research process or that business analysis process is the part where you go off radar, right? So you put the book stuff and the science part aside, and you schedule a one-on-one with company figures. And sometimes that's very difficult to come by. But the Ghana Stock Exchange has rolled out a very nice initiative. The facts behind the figures, the market gets to sit with companies that are listed on the stock exchange, and we get to ask them questions, right? Sometimes you can write to the companies, ask them for exclusive tours of their manufacturing plants, and there you get to meet the people that work there. You get to see the love that people have for you see whether the workers are happy, and all of that counts. All of that counts, and it helps you fall in love with the company, right? For lack of better, it helps you fall in love with the company. And sometimes you need to get um, you get key findings. You need to ask these questions. You've already done your research. You already have some points that you found. So when you meet them one on one, you ask them, okay, I saw this and this and that. What do you think is causing some of these numbers to look this way, right? And then also you need to prepare surveys. Let's say, for instance, you see that the company's gross margin is going up by just looking at the financial statement. You've seen it's going up, but then you've not done a consumer survey. So you put together a very short consumer survey, you know what their target market is, and you go to the consumer and you ask them a series of questions, and you realize that from the consumer's point of view, the product quality is declining, right, over time, and the consumer is not happy about it. But then when you go into the financial statement, it looks like everything is good. The company is making very huge margins. So you're like, oh, okay, this is a good company, it's a good buy. But you've not factored into the part that's okay, the consumer that this company is targeting has not been excited for a while about the product quality, and hence if they decide to find substitutes for this particular product that they are producing, their gross margins may start dwindling. So by doing this extra work, which I call off the radar work, you uncover deep mysteries, right? So by doing this, you generate findings that are unique and they are exclusive to you and the work that you've done. Like it's as simple as that. What people don't see, you tend to see that in your research, and that will give you a very big plus, right? Now, what next do you have to do? You need to look at the risk and opportunities, right? The SWOT analysis, very straightforward. What is the company's strengths? What's the company's weaknesses? Okay, what are the opportunities? Okay, what are the threats? As simple as that. You put them down and you outline them. Now you try and find another way to look at all of these strengths and weaknesses, but through another sense. There are so many things that you can use. You can use the Porter's Five. I call it where the power lies, because there you see what their competitive rivalry level is. Okay, what is the threat of new entrants? This the new entrants who is coming onto the market. That do they have the firepower? Can they undercut? What is the threat of substitutes? Okay, the suppliers that they deal with, as the company that you are really modeling, do they have the bargaining power? Okay, the buyers that are buying from them, if the buyers choose not to buy today, what is the effects going to be? What is the demand of their products like? So you see that from all of the stages that we've gone into, you've not looked at the financials, but you have been able to build a strong opinion about what the business really is about, right? And I think that's a plus for everybody who goes through this process in trying to understand what a company really is about. So you've done all of your, they call it qualitative work, some of them quantitative. Now you go to the favorite part, where the part where everybody likes, and where Senior Michael Akpao and Julius will go much deeper into. My top level takes on that is better to always start with a simpler model. It depends on what you're looking at, really. You look for trends, plot them down. Sometimes I'm not a numbers person, having been a numbers person for a while, but I'm beginning to like numbers. But sometimes when you visualize or you plot something on the graph, you see the trend better, right? You'll be able to relate some of the drops to some of the events that you put together when you were doing your business analysis. Some of the news items that came that said, oh, Societe is leaving Ghana. So now you've seen that the market is selling off. So you'll be able to plot all of those things on the graph and give you a better perspective of things that are happening around the company, right? So what has been their key revenue trend? What are the drivers? Are there any anomalies? If a researcher who is outside Ghana picks let's say a banking company in Ghana, and the person hasn't done an industry research, let's say for instance. And in 2022, all the reports that they put together of competitors of that bank, they realize that, hey, everybody's impairment losses is high. Everybody's impairment loss is high, 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 high. He wouldn't be able to know or draw an understanding into why those anomalies are occurring. Because when they look at all the other years, everything seems to be fine. But because you've not done your industry analysis, you will not be able to tell that within that period, Ghana's financial system went through a very huge domestic debt restructuring, right? And it even informs how you look at the company going forward. Okay, what is their exposure to government securities? Okay, are they reducing their exposure? Like, all of these insights will begin to pop up as you look at the company going forward. You see the trends. Does the trend match with the projection targets by management? So you've already done your management analysis. You've seen what management wants, who are on the board. Okay, what they said, they want to reach NPL level of so and so by so and so. Okay, when you look at NPL levels from their financials, okay, does it really click? Then you move on. Now, what are they really spending their profits on? Is it capex? Okay, the capex that they are spending on, is it mandatory? Is it discretionary? So let's say, for instance, you're looking at a company in energy, and let's say maybe it's a hydro generating, or it's an IPP, and the turbines that they bought is not a Francis, then it's a question mark. So by doing your industry research, you'll be able to unearth the fact that the Francis is one of the high-tech innovative turbines that you need to use in modern electricity generation. So by doing your industry research, you'll be able to, you'll be able to show that you know what you're about, right? You'll be able to state some industry innovations, industry equipments that need to be used, etc. Okay, they spent on something. It is not the Francis. What did they spend on? Okay, is there a new product that is much more efficient than the Francis turbine, etc., etc. You draw insights from all of that to make your research work better. Now, you don't have to overlook the notes. You don't have to overlook the notes. It's a very important thing that you have to do. Don't overlook the notes. The notes give you a lot more deeper insights to the company that you're looking at. Trust me, you don't have to overlook the notes. I can't stress it enough. Don't overlook the notes. In the notes, you'll be able to find out this company that is making very huge revenue, making a very huge revenue generation. Who are they really selling to? In the notes, you realize that really, since 2010, the largest people they've been selling to are related parties. So parties that are related to the business, whether subsidiaries, etc. Third parties contribute just about 10%. Then you flag that. So that could be a problem if there's a problem with the parent company, or there's a problem with the subsidiaries, because they are their subsidiaries, they do business with them. If something should happen, then how would they grow their third party relationships or the people that they sell with that third party? So by reading your notes, you'll be able to uncover some of these things, right? And it makes your your case much more stronger and much more rock solid. So yeah, look at the company, look at the industry, do off radar work, do your analysis on the company, looking at their financials, read the notes, and do go deeper into that in other subsequent areas. I'm just trying to clear your mind and build whet your appetite on the research work that you are going to do. So you look at all of these areas, and then sometimes you're looking at a company because you want to add them to maybe, let's say, a portfolio, right? And let's say it's a company that's issuing bonds, or it's a company that's issuing commercial paper. You need to know what the rating of the sovereign is, right? What has been the trend? Is it the right place? Okay, what happened in 2005? You need to build your credit rating trend. So build a trend. What happened in 2005? Okay, what did we see here? So in the past, there's been 10 downgrades. Okay, who and who are downgrading the company? The sovereign. Okay, so that means that the sovereign is in debt sustainability place that is not really good. Okay, so what's the recent news? Okay, Ghana receives rating boosts from Moody's. Okay, they've upgraded them to a CAA2. Okay, what does it mean? Sometimes the rating of the company doesn't so much affect the rating of the rating of the sovereign doesn't really affect so much the rating of the company, right? So you have companies in certain sovereigns that have been downgraded, but they sometimes have higher ratings than the sovereign itself because of the way the company is run, because of the view of the rating agencies about the company. So there are rating agencies that you can look at: Fitch, Moody's, S&P. Their reports are out there, very easy to access. You can look at Augusto and Co. You can look at Data Pro, very good companies that do analysis on companies. So it's a wide range. Sometimes you're analyzing a company because it issues fixed income, it's a corporate bond, you want to add it to your portfolio. You need to look at some of these things, very important. Now you've done your credit rating analysis, you've done all your other things. Now you also want to know what's happening in the economy, right? What's happening in the economy? You need to understand the economy the company is in. Yeah. You need to understand the economy the company is in. And you need to know what the projections are. What is the IMF saying about this company, this country? Okay, IMF is saying that real GDP will be at this level by 2027. Okay, what is the Ministry of Finance of that country saying about itself? Okay, they expect it to be at X level. Okay, what is Fish Solutions saying? Okay, what is the World Bank saying? Right? All of these things you need to plot to see them visually. When it sticks in your mind, when you have it in your mind, sometimes when you are on the stage and you are asked the question and you are a visual person, it's easy for you to see what the trend was to be able to explain to them when you don't have a slide, right? So you need to know what the trend is, what the projections are for that company. You need to know what the global view is. Okay, the company is situated in about 20 emerging market economies. Okay, what is the projection of emerging market economies? Okay, they are going to see a drop from first quarter 2025 all the way to, okay, what's this emerging market economy, sorry, and what's developed market economies? What's the growth going to be like? What's the forecast? Okay, if that's what the forecast is going to be, then it means that there's going to be a little bit of constraints on the market. If the economy is not growing, it means maybe interest rates are high, borrowing rates are high, therefore it's going to stifle business growth. That could affect the company that you are researching on or that you are building your business analysis on. So plot your graphs and do your calculations. Now, when you move from that higher up level of looking at the whole, economy, you need to drop it down a little notch. Look at, okay, sectorially, you're looking at Bob. Bob is agriculture. Okay, what has been the contribution of agriculture to nominal GDP over time? What is the forecast? What does the Ministry of Finance say the forecast is going to be? What does the Ghana Statistical Service say the forecast is going to be? Are they going to contribute more? Is the contribution going to drop? And all of these things will form the assumptions that you'll be using in valuing your company, which will be taken care of. Now, you've looked at all of that. Key components that you also need to look at if you're looking at a company, let's say in Ghana or any company, any other place in the world, especially multinationals, you need to look at currency, right? You need to look at currency. How much, what's the strength of the currency? What's the depreciation level? How does it depreciate yearly? How does it depreciate quarterly? Does it appreciate? Does it have a level of strength against the US dollar? Okay, how does it do against the euro? How does it do against the pound? If it's a continental company, okay, it's in, let's say, Botswana. Okay, what does the Botswana pula do with against the Ghana cedi? Okay, what does the South African rand do against the Ghana cedi on a quarterly basis? This would give you context, especially with companies that have very huge ambitions, that are into tech, that bring in a lot of machinery into the country to do their business. So I'll give you a very classical example. There's this gentleman who joins the MTN facts behind the figures call every single quarter, and he asks two questions, right? The first question you always ask is, what is the FX component of your capital expenditure? And the board or the figures, the high figures in the company will answer. His next question is, okay, do you find difficulty in accessing dollars at this point in time? Then they would answer. That is to help in his personal research work, right? Or in the model that he's been building over time. So at every single point in time, he comes, asks that question, and it gives him clarity of whether it's going to be a drain on MTN's business or whether it's not going to be. So from a research point of view, there are a lot of things that you can look at. I've not tackled all of them. There are a variety of things that you can look at. And I'm sure as you do your research work, as you do your reading, you'll come up with quite a number of them that are outside these areas: inflation, monetary policy. It could not just be for mining. If you are doing any other research work, you realize that other things will come up that would make a lot of sense to you. So yeah, that's pretty much about it. Now, if you want to look at a mining company, you need to understand a few things, right? Now you're looking at a mining company. Okay. What are really the types of, you need to understand mining. What are really, you are not a mining expert, but you need to have a little bit of knowledge about it. Okay. Mining is into, Asantigo says maybe it's into underground mining. What's underground mining, right? What's the surface mining? You need to understand what surface mining is. Okay, so that's the stripping of the overbedding. That's what they call it. So the resource is closer to surface level. So you strip the surface in bits until you get to the resource. You tap it out, and then you take it to the lab, check the grade, and then you process. Then you refine, and then you are in business, right? If they do that analysis and they realize that the cost benefit analysis is not, doesn't look good enough for them to do surface mining, then they have to find an alternative, which is the underground mining. So they go deeper under the earth's surface, and then they do mining from underground, right? Sometimes, if you understand these two, you know that, okay, ore level or the resource level is a little bit close to surface, right? It is based on the technical reports that came out. There's also another very strong composition of grade of gold or any other mineral that is underground. So the company might say, okay, we'll start with stripping the overbedding or stripping the surface, and then when we gather enough revenue, then we'll move into the section where we'll use part of that revenue to channel our business into an underground mine in this particular area of that very large land scale or that very large resource. So you need to understand what surface mining is. You need to know, okay, is the company doing surface mining? Is it doing underground mining? How much does it spend with surface mining? How much does it spend with underground mining? Okay, if it's underground mining in Canada, how much does it spend? If it's underground mining in Ghana, how much does it spend, etc. Now you need to know the mining chain. Exploration. What really is exploration? Well, they're drilling strategic holes into the resource. They're checking where the resource components are. They'll take it to the lab, be verified, etc. Okay, take your geologists there. They do all of that work. Take it to the lab, confirmed, done. Now, when you do your exploration, you build your mine sites, and that's where all the capex goes into. You build your plants, you build your campsites, all of those other things. Now you do your blasting, you plug in your cables into your chargers into the ground. You drill holes, plug in your chargers, do your explosion, you haul all of the resource, the landmass, you put them on conveyor belts, you take them to the processing center, you process them because gold usually comes with other related minerals, and that you would find when you do your research. Okay, now there has to be process. When the process is processed, what level does the bullion come to? Does it come to 90%? Does it go to 80%? Then after, okay, it's refined. You need to understand this process very well because it helps you in understanding which level the company is at. Where are they? Are they at the blasting phase? Are they at processing phase? Have they already struck gold? Have they made their first production, etc.? Right. And then from the Gold Council, the likelihood of discovery leading to a mine being developed, etc., is less than 0.1%. So you need to know if a company is solely into exploration and mining, then you need to know that this is the probability that they are dealing with. If it's a company that is into acquiring mines that have already been proven to have gold composition or spodumene composition or any other thing, then you know that, okay, this is how I look at them and this is the prospects for that company, right? And then you need to know the timeline, right? In exploration, okay, how long does it really take with exploration, right? You look at exploration between 1 to 10 years. What really happens? So there are levels of it. So there's when you're exploration, they call it inferred resource. So here you say that okay, in this 20 acres of land, we estimate that there's going to be gold. We have limited data, but based on the country's gold belt, we think that, for instance, the gold could be between Labadi all the way to, let's say, airports, and then all the way up to Jowulu, and then Accra Central, and then Labadi again. Cool. Now you move to the next level where it's indicative resource. Here you do the same thing, but with a little bit much more confidence, moderate confidence, right? And then you move to another level where it's measured resource. So here you've narrowed it down to, okay, within this range that we said, we infer that there's resource. The resource is actually Jubilee House, right? It's inside Jubilee House. Okay, cool. Then we need to do the mining there because we've done strategic drilling in that area and we have verified samples from the lab to say that, okay, this is where the resources and this is where we map that out and then we mine there. Then you go to the mine development, which I've already spoken about. You build your campsites, your plants, etc. That's where the capex spending is. And then you go into operations between 10 to 30 years, according to the World Gold Council. That is where your operation costs really are at. Sometimes you can be operating, but on the same very large resource size, you are doing explorations in other areas. So yeah, those can go side by side. Then you come to the place where you decommission, right? You've done all of your things. You think that you've mined the high grade gold that you can, and now you want to decommission the mine, right? So you need to make sure that between that period, the chemical composition or the chemical concentration in the soil is at EPA standards, right? Environmental Protection Agency standards. And you need to make sure of that, right? So you go through a process with specialists, etc. You need to know where the company that you are analyzing on where they are at, right? In any of these stages, it helps you in the way you deliver on when you're speaking to trustees, you're speaking to investors, you're speaking to any other person, right? And then post closure, after you've closed the mine, you need to come back and do some work on it. You know, whether you want to plant grass, based on the conversation that you had with the community before. Maybe you build a nice hospital, you build an astroturf, all of those other things. So these are the timelines. You need to know where the company is at every single point in time. Now, there are things that when you're looking at a mining company, people tend to overlook, right? Which I don't want you to. We are not experts. I'm not an expert in mining, but you don't need to ignore these images because they help you understand, right? So when they drill the holes, like I said, so in all of this, like I said before I came here, I've also had one-on-ones with some of my friends in the industry, right? My best friend is in mining, my cousin is in mining, so I spoke to them, right? And that's also gathering information to deliver, and that's what makes research a lot more interesting to me because it helps you build a very strong bond with other people in industry. You tend to learn a lot, and you build knowledge, adds to your learning curve. So yeah, so these are the great compositions. It goes from the lowest all the way to the highest. And this is for lithium hydroxide. This is from a technical report that I pulled out of Atlantic Lithium. So this is on lithium. And then like I said here, right, you see the inferred resource in green, like you see the indicative resource in blue, you see the measured resource in red around this area, right? And all the other things that I spoke about. So you need to look at some of these things. Okay, this measured resource, what's the composition, what's the grade level, etc. You're not an expert, but by looking at some of those things, it gives you an extra edge over every other person who does not look at them. Cool. Now, you're looking at a company that's listed, not just in Ghana, but other places in the world. You need to be abreast with what their price trend is across the world. So Asante Gold, for instance, listed in Canada, Frankfurt Exchange. It's on the OTC markets in the US. It's in Ghana as well. Okay, when did they list? What's the market price initially? What's the market price now? What's its tradability? How liquid is it? What is the price level? What's analyst recommendation? You need to read those things. Sometimes it helps you to build a better research report or even in your valuation. Right? It gives you a view, right? It gives you a view. It depends on how you do your valuation really. So yeah, you need to know what the company is doing in all those other areas to inform how you speak about them. I've spoken already about it. So you need to go through some of these. So this was a report, technical report that was issued by the Ghana Stock Exchange from Asante Gold in April 2022. Sorry. You need to look at them, you need to read them, and you need to investigate. Okay, what's their all-in sustained cost? What is their gold production level? What is their total cost per ounce? Okay, they have a mine in Kubi, they have a mine in Chirano, they have a Bini mine. Okay, how's it doing? You run an analysis just like we've done in all of those break areas. So you build your reports brick by brick, right? And at the end, you come up with something that is concise, and that sells your story better. Now, I'm drawing closer to the end. Now, you look at ESG, very, very important. So the world has come to a place where we're not just looking at companies that are profitable. We want to look at, you're profitable, but what's your effects on the economy? What's your effects on the environment? What's your social impact like, right? So you're looking at the company, but you start from the sovereign level. Okay, what's the sovereign's ESG profile like? In some of these research reports, you can get them on the Sovereign ESG data portal. You can get them on Bloomberg. You can get them on S&P Global. You can get some of them on the Minerals Commission, etc. So find out, read wide on what ESG is about. Read wide on where you can get some of these numbers from, and Are there any industry guidelines for listed companies in Ghana? Does the GSC have an ESG guideline? Go look at that. Okay, when was it issued? What are they saying? Uh, what is the company's carbon footprint? Okay, what are the internal ESG policies? Do they have ESG champions in the company, etc.? Who is championing it? Okay, what is their greenhouse gas emissions intensity per revenue? You look at that, and that's one of them that I shared down here. So they call one the scope one, they call one the scope two. When you read into ESG, you'll be able to understand all of them. So the scope one is usually direct emissions, and scope two is indirect emissions that comes from maybe the use of electricity, right? And then they give you an industry peer median as well, right? So this is for Anglo Gold Ashanti on the Johannesburg Stock Exchange. Now, one very key thing that you should know also is um, for companies that are listed in Canada and other places in the world, they are expected to do an Extractive Sector Transparency Measures Act, right? This is to let them know how much money are given to government officials, etc. Something that you should definitely look into. Now, I'm wrapping up. You need to look at the price volatility. You're dealing with gold. You go into meetings, you pitch gold, but they'll ask you, people will rather prefer holding dollars, right? So what's your play? You need to find what the correlation is over time, where the good time is to come in. So when you look at from February 2022, when the Russia-Ukraine invasion happened, there's been a 26% correlation, negative 26% correlation between gold. So when people are not doing gold, they're trying to do dollar. So you need to read around these areas, capture the key events, catalog them, and then make them inform your decisions, right? Now you look also at, okay, gold. Gold usually does well when there's geopolitical tension, some people would say, which is actually true. But there are also other events that sometimes trigger gold. Okay, what are the events? Okay, when the Fed kept rates the same, we saw gold rise up all the way above 2,200 US dollars per ton. Okay, that means that people were expecting inflation to be higher, so people try to hedge, right? So you need to look at all of these events. So you look at gold, look at oil. Some of these things they usually move closely in line. Sometimes you can see signs from oil, sometimes you can see signs from gold. So look at that. Now, what is markets? What's the market's fear gauge? So because when the market is afraid, that's when they usually go to gold, right? So you need to look at that area as well. What's the volatility like? Okay, is it likely that people will be heading towards gold in the few years? What does it do to the Asante Gold business? Okay, so and so, so and so, so and so. So all of these things would, like we've run through, it gives you a clearer mind on the kind of company that you're working on, the industry it's in, and the effects that some of these things also have on it. So yeah, it's a lot of things, but yeah. Now, in closing out, you put together your executive summary. You do all of the things that you've done. You just break them down. It's a very nice part. This is the part where everybody wants to see, yeah, but not the work. So it's company overview, management, governance review, industry analysis, financial analysis, you do your competitive analysis, you do your market and economic analysis, growth potential, and you've already done all of this work, right? Valuation, Julius and Michael will take that. You do your risk assessment, you do your conclusion and your recommendation. And trust me, sometimes your reports is likely not going to be conclusive, but really it will be useful because of some of the things that you put in your presentation. So yeah, it's a lot, but this is what I really love to leave you with. And thank you very much for the opportunity. I think this is time for questions. Yeah. Yeah, hi, Free. I don't know if I can be heard, but can I be heard?
Yes, please, you can be heard.
Okay, awesome.
Hear me.
Yeah, I can hear you, but I think your line is breaking a bit.
Yeah, hello.
Yeah, I can hear you much better. Thank you.
Thank you so much for the session, Daniel. I was saying that it's been quite insightful. I have learned so much, and I'm not even writing a report right now. So that was fantastic.
Thank you very much.
If you have any questions, please, this is the time to do that. You can unmute yourself, introduce yourself, and then ask your questions. We have some time till the next session, which starts at around 12. So just trying to see if we have questions, get them through. Daniel will assist us in responding to them. If you can unmute yourself, you just raise your hand, we unmute you, you ask your question. If you'd like to type it into the chat box too, that's also welcome. So for the next 15 to 30 minutes, we are trying to take questions from this side before we move on to the next session.
If
Yes.
yeah, students don't really like to ask questions. I've been there. So I'll share a question that maybe somebody might want to ask.
Okay, that's
So
fantastic.
where would you really want, where can I find the data? It's usually the questions that you really get, right? Because it looks very rosy when I go through these slides and you need to do this, you need to do that, you need to do, but where do you really find the data? So yeah, you need to, like I said, you need to know the people that regulates the industry. Sometimes you would not find the data that you're looking for, right? So sometimes you need to compromise and use other data points. Sometimes you can be able to infer from market share and sometimes based on, so if you're looking at revenue, right, and you're looking at loans that have been given, and in the industry, you know that okay, this is the amount of loans that have been given out. Now you have models for each and every bank that is listed in Ghana, right? You know how much loans they give out. You can be able to do a simple math analysis. Okay, what is this their percentage of the loans that were given? So then you can be able to tell that okay, even though the data is not available like readily, you can be able to do your own calculations to be able to come up to that conclusion. So go on the GSC website. There's a very good portal that has been built by Niam Pasoa, works at Data Bank, solid guy, never met him before. But I use this platform a lot. Annual Reports Ghana has a lot of data points, has a lot of reports on all the companies that are listed on the Ghana Stock Exchange. Like, do check it out. It's going to really help you. So that's just one bit, just to warm them up for questions. I think there's a Dariska that has a hand up.
Please, I've unmuted you, so you can go ahead with your question.
So thank you, Daniel, for the presentation. I'm Fabiola from KNUST. I'm a third year, final year banking and finance student. And I wanted to ask, since it is reported the Asante goal, like the finance is reported in dollars, I wanted to ask if we should convert it into Ghana cedi and which rate are we going to use for that?
Yeah, that's a very good question. It's a question that I would love to leave to Julius, but I'd like to tackle it. Usually, for me, for instance, because of the resource that's available to me, and because of the fact that we are transaction advisors or we're transaction advisors and arrangers to Asante Gold, I wouldn't have that problem. But for students like you who who are doing an analysis such as this. I think it would be better if you could maybe first and foremost reach out to Asante Gold and try and like I said in the beginning, sometimes you need to try certain areas first. When you do that and it doesn't work, then you can go into extrapolating. So they used to record in Canadian dollars. Now, like you rightly said, they've changed accounting policies and now they're now doing it in USD. You can do the extrapolation, and in my view, but then also you need to use the right rate. So what is the right rate that you should use? You should find that in some of the reports that they put out in their financials. There should definitely be um, um, a cross rates, which they call it. If you don't find that, then you can check out Bloomberg, find out spot rates around that period, or maybe also you can use the interbank numbers. But definitely, you should be able to find something on their website that would help you tackle that.
Thank you.
I think we have another question in the, okay, Johannes.
Hello. So my question is in relation to the competitors. So are we supposed to consider companies that have like their mines, or at least one of their mines in Ghana? Are we limited to just considering companies that have at least one of their mines in Ghana?
Yeah, that's a very good question, Salma. Thank you for that question. I think you would do yourself a lot of good if you look at companies that are not just in Ghana. So look at their close rivals, who they themselves say their rivals are, is very important. And then you also look at other companies that listed probably in Canada, listed in Ghana. And like I said, look at people that you think do similar business with them, right? You'll be able to draw insights from what they have done differently in Ghana. Asante is really an acquisition sort of business. So you need to look at that area very keenly, look at other companies that are doing similar, and then you'll be able to come to the conclusion that you should come to by the question that you asked. So look at their competitors, not just in Ghana. Look at those that are cross-listed. You can even look at companies that are not even listed in Ghana and in Canada. You can look at other areas, maybe Australia, etc. It spices up your research, and when some people are doing one specific thing, then you are the curveball that is amongst all of them doing something different, which will give you a much more color than all the other people may have given. So yeah, that's pretty much it. So look at it holistically. It will help you build more a stronger opinion, yeah, for lack of better words, about the company, yeah, and its competitors.
All right, thank you.
I think I saw someone's hand up, but I'm unable to see the person again. You can unmute yourself, please, and ask your question. Should we assume that everybody is fine with this session and we can move on? Okay, there's another hand up. Blessed, you can unmute yourself.
Okay, I'm Blessed O'Connor. The mining business is very risky. So, in your view, what will you say what are some of the things we should look out for when we are assessing the risks they face? Can we include things like this since last accident and things to bring out how safe they are and stuff?
Yeah, that's definitely something that you should look at. And when you look at the process that I mentioned, when you look at some of these things, you see sometimes some of these things look trivial, right? But these are sort of indicators that are looked at when you are in the mining industry. Sometimes they even look at, okay, do you have very strong labor unions? Okay, are your people paid right? Okay, how many community people do you employ into? So it depends on the scale of research that you are doing, right? And I need to put in the caveat. You need to start from a place where your model or your analysis is not so complex. And as you go on, you build on that, right? So those are things that you might do later on after you've done maybe X and X areas. You've done the top level things, and then you realize that, oh, okay, no, but there's something in the news item that says that, okay, the BBNE mine, due to improper explosion at X and X area, it led to the collapse of the mine, and X and X people were lives were lost. That's a big news item. It affects Asante Gold. Okay, then it's something that I need to drill down on. So I think it's more of an art than a science. So you can be flexible, but you also have to be careful that you don't overcomplicate the research work that you are doing. Else you end up like cramming up. So you need to look at the bigger picture, and then you zoom in when you can based on the kind of things that you find out. So yeah, that's what I'm going to say. Yeah, bless.
So, with the current view of mining in Ghana at the moment, assuming international or foreign investor wants to invest in mining, but then they are sort of spooked by how the entire scene looks right now. What advice will you give us so that we can quell down their worries?
Yeah, I think you're asking the question very rightly. Galamsey is a very huge menac for Ghana. It's very sad that we can't keep our water bodies very clean. Sad that we can't differentiate what greed is from what life is. So you can come from the emotional side, but you can also come from the part where you are very stringent. In whichever way you want to come out from. But I think in your industry analysis, that should definitely play in, right? You need to label it, and you need to label the fact that Asante Gold is not in that region. It's licensed because first and foremost, illegal mining, which is termed galamsey, is mining without a license. But then also you've had reports of companies that have licenses that are engaged in it some way somehow. So your reports should cover the fact that okay, Asante Gold does this. It's licensed. Okay, it has ESG policies that I'm doing the research work for you. So it has policies that make sure it does this and that and that. And then these are its ESG rules. Every single year or every single quarter, it has a report that it has to do to the GSE on the GRI standard. And this is what has been done. So even though you have this Galamsey Menac and you want to invest in Ghana, what you have to do is you need to invest in Ghana, because if you plot out the top 10 or maybe the top 8 companies in the world that are very large producers of gold, Ghana falls in there. We acknowledge the risks, we acknowledge the scene, but these are the opportunities, right? So in your research work, you find out a lot of things, right? Opportunities. And it really depends on how you spin it, right? And it really depends on what you place value on. So if in your research work or in your mind, you place more value on the risks, then is the right word poisons? Yeah, it poisons your view on the company or the industry. And then that would inform the kind of passion or the kind of excitement that you will use in talking to the international investor on investing in Ghana and investing in Asante Gold, which is a company that's mining in Ghana. So you need to do all of that work, but then you need to, in your analysis, like I said, look at what it's doing with ESG, look at what's doing the CSR, okay, what social initiatives, what has it done in ensuring that it has the right chemical components in the soil after it decommissions, okay, what's it doing for water supply, how is it helping communities, and etc. So all of those things that you do in your research work are supposed to allay all of those fears of the international investor and bring them to a point where they understand, appreciate, or they walk away based on the level of research that you have done for them. And then they can make a decision whether they want to invest or whether they don't want to, based on what your research work has placed much more emphasis on. So what is your research work placing emphasis on? Is it the fact that there's galamsey and every single mine has to be shut down in Ghana, or the perpetrators have to be put to book, and all of that thing? And this is what ESG, these are the ESG practices of Asante Gold, these are the ESG practices of maybe Newmont Ghana. And even though this is happening in so and so, they are not close to it. This is what they are doing. And this is how it helps the situation. And this is what we want other companies to emulate, etc. So it really depends on the research work you do and the conclusion that you come to and how you tell the story. So it's a story, and it's how you tell it that would help you sell it to the investor and will help them bring you that bulk of money to invest.
Please, do we have any more questions? Okay. Okay, so we'll be ending this session at 11:35 if we don't have any questions, and prepare for the, okay, there's another question from Bliss.
Okay. Sir, please, what advice will you give us on the conversions in case the company doesn't follow the metric system?
Ooh, that's a good question. Like I answered before, you should try. It's a very dicey question to answer because it has implications on what your model is going to do, is going to look like. I'd really prefer Julius to answer that because he's done a lot of valuations. He's had quite a lot of experience on multiple ones of them. He would know how best to address it. It's a really tempting question to answer, but I think you should wait for the basic um, mining valuation tips from Julius. I'm sure he'll clear that out in seconds. So yeah, I'll leave that one to Julius. Yeah.
Okay, thank you.
You're welcome.
All right. Still have 1 minute to go before we wrap up this session. Okay, I guess we are good to go. Daniel, thank you so much for your time and for sharing your expertise with us. We really appreciate it. And yeah, if I don't know if you would be staying for the other sessions or you would leave us here, but what
No,
would be?
I'll definitely stay.
Oh, that's
Because yeah, my bosses will be here, so I need to pick a few insights for myself. Yeah,
That's fantastic.
yeah.
So, any last words for them before we would go on a quick break? Because Julius's session starts at 12:05, and then since we wanted to give them enough time for Q&A, but since we are done with that session, we have a short break. Come back at 12:05, and then we take it from there.
Okay. Yeah. Just go about doing your research work. It will look very daunting in the beginning, but just you build confidence and fall in love with the industry, fall in love with the company. And I think that should inform your passion in talking about them. When you speak about a company with passion, that is the main thing that really convinces people to invest in it, or whether you really convince yourself personally that it's actually a sell or it's a buy. So yeah, focus on that and focus on building that research database, or yeah, that research database that brings you to that conclusion. Trust in you guys. I know you guys will do awesome. Yeah, and be innovative. There are things that I might not have said that you can put in your analysis, and that would help you. Yeah. So thanks to the CFA Society. Thank you, Ikea, and everyone else. Yeah. I'll see you probably, but I'll be on the call. But yeah, thank you.
Thank you too. So we would go on a short break. We will be back at 12:05 for the session on mining basics, mining evaluation basics. So till then, you can hang around or still be on the call or log off, and then we'll come back at 12:05, exactly 12:05. Okay, thank you.
Good afternoon, everyone here listening to me. I'm audible, please.
Yes, you are, Julius.
Yeah, good.
Okay.
Let me see.
Yes.
I have
Request to share your screen, and then I would hand it over.
okay, sure, very soon. Okay, I have a number of people here.
Yeah.
My screen. Okay, good. So let me request to share my screen. I think I have my slides open. Okay. So I'm sharing my screen now. My screen is quite messy. Okay. So can you all see my screen?
Yes, please.
Okay. I got to put in a presentation mode, so let me do that. Yep. One step. Just one step. All right, good afternoon. Let me hear from everyone, especially the participants. If you can all unmute your mics for a moment. And first, I would like to know okay, so if you could do some introduction from their end to me, that would be great. Maybe the category of participant.
Hi, Julius. So we have the teams for this season's research challenge. So we have teams from the various universities, Ashesi, UPSA, UG, UCC, Academic City, and KNUST. Yes. So we have those teams on the call. So they are participating in this year's research challenge. Yeah.
Okay, good. Great. Thank you very much, Ifri. All right, so guys, how are you guys doing? How is the preparation going? So unmute yourself and you can just speak once you get yourself unmuted. Otherwise, I'll start mentioning names. Are you guys here? Emmanuel, can you hear me? I want to ensure everyone is hearing me.
Yeah, I can hear you.
Okay. Okay. Good. So team UPSA, let me hear from you. How is it going? And what's your expectation? What do you want to learn? What's your objective in this particular session? I want to hear from team UPSA. Team UPSA. Is team UPSA there? Okay, let me hear from team KNUST.
Okay, so thank you for having us. We hope to have a very insightful and educative lesson. Mostly, I think we've progressed well so far. We are having some challenges with the forecasting and evaluation side. So we'll really love it if you could take your time and then go through that with us very well so we can understand.
Okay, that's team KNUST, is that correct?
Yes.
Okay, let me hear from team Legon, University of Ghana. Hear from team Legon. Is anyone there from Eugene? Out of Team Cape Coast. Can I hear from Team Cape Coast?
All right. So thank you, Julius, for the opportunity. So this is Team Cape Coast, and the expectation is high. Currently, we are working on the business analysis aspect, and we are going furthermore with the evaluation aspect. So we are waiting to see how you take us through the mining evaluation. So yeah, that's the expectation from your side.
I see. Great. Great. And Academic City, next. Let me hear from Academic City. Let's be quick, guys. We have a lot to discuss within the limited time. Let me hear from you quickly. Once I mention you,
From Academic
I
City,
want to
we
hear
are
from
hoping to, sorry, and we're hoping to really get a lot of detailed information for the evaluation, since that's going to be mainly what we need for our research. So we're hoping to get thorough explanations and understanding so we can implement it in our research. Thank you.
All right, thank you. And so I've mentioned Cape Coast, I've mentioned Ashesi. Is Ashesi here? Team Ashesi. Let me hear.
Okay, so yeah, we hope to get more knowledge about the valuation, specifically in the mining industry, as it's quite different from what we are used to. So they'll be able to get like the intricacies to be able to better our research and our valuation methods.
Okay, great. Great. Thank you very much, everyone. And I'm happy to have you here. So let me provide some information about myself. All right, so my name is already displayed there. Julius Ebenezer Akpe. I'm a CFA charter holder, and I'm currently a manager with the deal advisory team in KPMG. And I've been the technical lead on several work, almost to say the valuation lead for KPMG Ghana. I spend a lot of time training the West African team. So I trained the Nigerian team and the Ghanaian team on business valuation and transactions. So I've been doing financial modeling training for some time now. I do it across several industries, and I've trained several professionals in a similar field. So I'm happy to be here today to share my knowledge on the subject matter and also answer your questions, because that's quite key. Now, so the understanding is that we are working with Asante Gold Corporation for as the case study, right? The subject company is Asante Gold Corporation. And I understand that you've had some discussions on that in terms of the earlier lecture highlighted some business analysis and all that on Asante Gold. What I'm going to be doing is that I'm going straight to look at valuation. I've just been given an hour and 30 minutes. In a standard lecture where I have to tell you about valuation, I can spend 10 to 12 hours talking to you just about a discount rate, cost of equity and all that. I could spend like 10 hours telling you just about cost of equity and the weighted average cost of capital. So you just imagine how a lot of things I'll have to pack them into an hour and a half lecture. Beside that, if I have to tell you about valuation, about discount rate for 10 to 12 hours, I'm going to be telling you the full story about everything. But the good thing here is that I'll just have to focus on the subject matter, and then we see what we need to get our work done. I think that's the most important thing now. And that's what I intend to focus on. Good. Now, what we have we want to talk about mining, and I believe you've also already had some lecture on that to some extent. Valuation generally, but well, before I even start, let me tell you about the structure of the lecture. I'm going to use an hour to teach you some basic or some fundamental of valuation, right? As we do it in practice. And then I also show you how your understanding from your classroom may differ from what is actually the best thing to do. And I'll help you to bridge the gap. Then I'm also going to talk to you about I'm also going to take questions from you, actually. I'll take questions from you for the other 30 minutes that'll be left. So prepare your questions down. Any area of misunderstanding, note it down so I can address all those questions. That's the reason why I'm here. We're just trying to do that within the time allocated. Now let's get into some few stuff. You see, there are several ways to approaching valuation. What I prepared to show to you on the screen here is just some few matters. A lot of things I'm going to see them in person. So you will have to listen carefully. And the reason behind that is that I have limited time to spend. So you won't expect me to, like show you everything that you want to see on the screen. How I'm going to be speaking on this topic, I want to group it into maybe to say 3 parts. First, I'm going to talk to you about what valuation is. When we say valuation, what we are trying to achieve, or what we are trying to value, or whose value, or whatsoever's value we're trying to determine. That's the first thing. And I'll tell you also, the various methods to arriving at that, the value. Then the second part, I'm going to tell you how we do valuation, what actually determines value. Okay? And that no matter the method you are applying, those are still the fundamental questions we ask. And in that case, I'll be talking to you about 2 broad things. Number 1, I'll talk to you about cash flow and growth. And number 2, I'll talk to you about risk. So there are 3 things that actually influence valuation: cash flow, risk, and growth. I'll combine the growth and cash flows, talk to you on one side. Then the risk will be the second side I'll talk to you about. Once you put those 3 items down, we have determined the value. When I start, I'm going to talk to you valuation generally as to how we value businesses. But my examples may be specific, and wherever the mining methodology differs, I'll highlight it. In terms of how we see things, I'll highlight them. Is that clear with everybody? Let me get you on board. Is that clear with everybody? Let me hear from you. Guys, this class is going to be, I want it to be more, how do you call it? Interactive than ever. That's how I teach. So I want to be hearing from you. You can't be silent. And so I know what is going on. Somebody put a message in the chat and say, yes, okay. Now, so let me hear from you. Is that okay with you? Are we on the same page?
Yes, please.
Good. Right, let's begin and talk about value. So what is value? Whenever you're doing a business valuation, so I'm going to be using these words: business valuation or equity valuation. I'll mean the same thing. Whenever you're valuing equities or even anything at all, there are fundamental questions you ask. Why am I doing what I'm doing? What am I trying to arrive at? So you're going to be meeting these various definitions of what constitutes value, like intrinsic value, going concern value, fair value, relative value. Right. A moment, let me push this to the side. Investment value. What exactly does it mean? You see, the value anybody puts on anything depends on the intention behind the valuation. Now, so if let's say I want to invest in company B, and so I want to value company B, and somebody rather wants to value the same company B, but the intention is not to invest. The intention is to sell the investment. How we will approach valuation will differ. The one who wants to invest in company B will be thinking about the potential value or benefit it's going to derive from getting that business be as part of his bigger business. Okay, so I'm buying one business and integrating into mine. He's going to be thinking about the potential benefit associated with that. But a guy who is trying to sell will not be looking at things from that perspective. Will probably be looking at how much or the value at which he can sell that business today. That may be, or that may be his attention. So you need to always know why you are doing this. And you need to state it clearly why you are doing this. Are you valuing Asante Gold to sell it? Or sorry, are you valuing Asante Gold for the purpose of a sales to an investor, or you want to advise, this is a research you're doing. You want to advise whether maybe the people who hold shares in these companies should sell it or they should buy it, or people who want to buy it should buy, or they should hold their shares or whatever. You're making those decisions. But then, as far as possible, for the purpose of the work we're doing, we are assuming that we are always taking the going concern approach. What it means is that Asante Gold will continue to operate into the foreseeable future. So once this is the assumption made, then some models becomes relevant. That is, models that take into consideration the future prospects. Now, some of these things we're going to be talking about it a lot in like intrinsic value or relative value. So I don't intend to speak much about them. But if you think about a term like fair value, if we say fair value, that is the value two well-informed parties have agreed or they are willing to buy or sell or exchange something of value. Two well-informed parties. An informed party, for that matter, is a party that is knowledgeable, that understands the item being sold or being bought. To say he understands means that he has done all the calculations and everything. He has a complete knowledge about the asset or the item being bought or sold. So if these two informed parties, they all know about the asset, they all know about the business, they all have the information about the business, they have the financial statement of the business, and they have done their independent analysis, did or conducted their independent valuation, and then come to a conclusion that so and so business is worth so and so. And then they agree that, oh, the share should be sold at 5 cedis per share. And then we say those two individuals have arrived at the fair value. That is a fair value. In other words, if I sit in my room and I perform this calculation, I'm taking an approach or I'm making assumptions which I believe that a third party looking at the same work will make a similar assumption. So often I do a number of this work each and every time. Of course, if our auditors are auditing financial statement of companies and there are some instruments on the financial statement, like they have some shares on the balance sheet of the company. Maybe the company has bought shares in another company. They need to value those items. If you have done accounting, you see the fair value standards. I think that should be IFRS 10 also. So is it IFRS 10 or IFRS 12 or something? So they have to value these investments on the balance sheet, and I have to take that on. Really, the lead person that does the valuation, and the approach we use is fair value. Fair value. Okay. Now, so why then do we do the valuation? Why wouldn't we just go on the stock market, pick Asante Gold price, and we are cool to go? Why do we still need to do valuation? You see, now, So if you look on my screen, although there may be actually the market price for the shares, we will still conduct the business valuation because the price the shares are trading on the market may not be reflective of their true value. And that's the reason why we need to do it. And that raises a paradox. When I was pursuing my CFA program, I think level 2, we met this Grossman-Stiglitz paradox, which says that if the market price, which are essentially freely obtainable, it means you can go to the stock market and you find it, the trading history is there. And any active stock markets, they have the prices displayed. So if the market prices, which are essentially freely obtainable, perfectly reflect a security's intrinsic value, then a rational investor will not incur the cost of obtaining and analyzing information to obtain a second estimate of the security's value. What it means is this: if the market price, the trading price, reflects the intrinsic value of the business or the true value of the business, if it's a reflection, so I can say that if I go to the Ghana Stock Exchange market and I pick a company like MTN, the share price of MTN multiplied by the number of shares outstanding for MTN, then I look at that and it gives me a value like, let's say, 100 million. Then I say, oh, that's the worth, or that's how much MTN is worth. So we are saying that, or what he's saying is that if the market price of that 100 million we have estimated is a true reflection of the actual value of the company, if that is the case, then a rational investor will not incur the cost of obtaining and analyzing information to obtain a second estimate. In fact, what it means is that there's no need for any research analyst, any equity research analyst, because market price is already giving us, the market is already giving us a price that we can all rely on. So what's the sense of going to do any analysis to obtain a second estimate of value? But then this raises the other side of it. So if no investor obtains and analyzes the information about a security, however, then how can the market price reflect the security's intrinsic value? In other words, how will we know that the market price even reflects the intrinsic value of the company if you have not attempted doing the valuation? Now, but then this also raises a couple of issues. This also raises a couple of issues. If you take a business and you have gone to do or perform some valuation and then come back and say, well, the current market price of Asante Gold is $5, but $5 or $5 USD, but I've done the valuation is 7, and therefore I think mine is correct. Not necessarily. Not necessarily. Not necessarily, because what you have estimated may not be the true intrinsic value. When we say intrinsic value, I'll come to that, but then what it just means is that based on the business's fundamentals, fundamental cash flows and all that, the potential of the business, how much it should be worth, and it's independent of how much people are paying for it on the market. How much people are willing to pay is the fair value, which is oftentimes the market value, but not at all times. Now, I'll explain to you why. Now, how much people are willing to pay is that, but you can collect good information on the company, all the possible best information. You have a perfect understanding of the market. Think about it. You're having a perfect understanding. Think about economics. Economics is built on the principle, all the theories in economics are built on the principle is that people are rational. And rationality means that one aspect of rationality is that people have perfect information, perfect knowledge about how the market operates. But then you can have a perfect knowledge about how the market operates. If you have a perfect knowledge about how the market operates, you have the perfect knowledge, then whatsoever estimate you are making is the true intrinsic value. But oftentimes, we don't have perfect information. We don't have perfect knowledge about the market. Therefore, our estimate may still fall below or drift away from the intrinsic value. So it means that it's not every estimate you end up making at the end of the day you can say with 100% confidence that this value is the best. Like, that's the true value of the company. And therefore, the share should be traded at this price or not. Not necessarily. So what I'm doing is that I want you to be aware of the markets, aware that the methodology you are using in itself is subject to several estimation error. Yeah, there may be errors in your estimations or your assumptions. The model risk is there. So you may not necessarily get the correct price on the market. Good. Now, let me talk to you about the valuation process. Usually it starts with an understanding of the business, and then we focus the company performance based on our understanding of the business and the business's strategy and all that. Now, if you don't work in the company, so you may not be privileged to internal information, in fact, very detailed information. There are times that if you're an analyst following a stock, you can contact the company for additional information. But in this, not all the time. And here, you don't have access to that. So all you have is the information made in the public, available in the public domain. And that's all you're going to be working with. Now, then you select a valuation model, an appropriate valuation model. And for me, what I recommend people do, and I always do, is I don't use a single valuation model when I'm valuing businesses. I use multiple valuation model, and I compare the output, I compare the assumptions. Some of these models are sensitive to some assumptions that I don't feel comfortable in applying them because of the sensitivities. Some of them just like, of course, if you look at history, you see that the trends in the cash flow is quite volatile and all that. Then I find it very uncomfortable using methods that depend so much on the forecast of future cash flows. All right. So then when you decide on your methodology and you also forecast the cash flows, they just convert the cash flows to evaluation, and that's really a bread and butter thing. It's not anything difficult. And then you then apply the conclusion, right? You form an opinion, what you do, whether to hold that shares, continue to hold, or maybe you think it should be a sell or it should be a buy or something, right, from your research. And you come up with your research report, actually, and that will communicate that point clearly. And the basis for that recommendation, investment recommendation, clearly stated, right? Now, I want to take an initial look at the word intrinsic value. Guys, are you there? So I don't keep talking without knowing that you guys
Yes,
are
we
there.
are here.
Yes, yeah,
Are
yeah.
you guys are you guys having some value out of my lecture? Are you learning something?
Yes, we are. We are learning.
Good. Now, so let me take an initial look at the intrinsic value thing and the rationale behind that. Now, when we talk about valuation, the value of a business is actually a function of three things: the expected cash flows from existing assets that they have, then the growth potential of the cash flow that will come from the additional CapEx or capital expenditure they are making, and then risk. Okay, so cash flow from the existing business, then the growth potential in cash flow, which will arise from additional investments, and then risk. So that is actually the fundamental way of thinking about valuation. And it's a call to everything we do in business valuation. Now, I use business valuation because we first determine the value of the company. Generally, that's what we do. We determine the value of the company, and then we divide it by the number of shares the company has outstanding, and that we determine the share price. So often what I mean is that we determine the market capitalization first. Right. So three things, don't forget in everything you do: the expected cash flow from existing asset plus potential growth in cash flow arising from existing investment or new investment, then risk. So the value of a business is a function of those things. Right. And so that is intrinsic value. Now, so discounted cash flow is just one of the tools used in intrinsic value. What's happening here is this. Businesses, we assume continuity or going concern. So what it means is that the value we put on a business should be the value we put on all the benefits we expect to get from the business. So the value of anything is the benefit I intend to get. Everyone rationally will put a higher value on anything that gives him or her a higher utility or a higher value or a higher benefit, a bigger or a greater benefit. Because economics tells us that humans are selfish. You see, humans are selfish. That's assumption. And so they will always go for what gives them the best satisfaction. So it tells us that the higher the benefit we expect, the higher the value we put on that. All other things being equal. Now, but see, the benefit I enjoy today may not necessarily be the benefit, the same amount of benefit I enjoy tomorrow. Okay. Benefit, the value of any benefit is a function of time. As to when I expect it, it's a function of time. If you are promising me something in the future, and you're asking me whether I should choose between the thing now and the thing in the future, I'm likely to prefer the one now because for several reasons. Number one, you could die. If you die, I wouldn't get it again. Number two, by the time we get to the future, I may have that myself. So I won't put much value on it again because myself, I have it. Okay. Number three, I think I just feel like enjoying it now for several other reasons. Let's look at that argument properly. If you tell me that, Julius, I want to give you $100 now or give you $100 in 3 years' time. And then, of course, all of you here will say time value of money. That's the first thing that comes to mind. I agree. But then if I ask you, why do you think you prefer $100? You tell me time value of money. And I say, why? I know the answers you're going to give me. Let me get the first two answers. Someone should give me why time value of money matters here. Why you prefer $100. I know it's time value of money, but why? What is that informing the time value of money? Let me hear from two people quickly. Let me hear from two people.
Yeah, hello.
So I think
Okay, who is speaking?
Yeah, hello.
Yeah, proceed. Yeah.
Yeah, so the reason why our factor time value of money is because of inflation. Yeah.
Good. Inflation is one reason. Because it tells you that $100, what you can use $100 to buy today, you may not be able to use the same $100 to buy tomorrow. Guys, I know a lot of people say dollar value is rising. Forget about that. Let's just say we are living in a world where we have only dollars. Okay. So inflation is a good response. Who has something else to say? One other response. What could be another reason? What could be another reason?
Okay, so
yeah, let me hear you. Yeah, come on.
I could invest the money today and then make some returns on it.
Okay, there's a term for that. It's called opportunity cost. So another reason is opportunity cost. You could make some returns on that. That's opportunity cost. That's correct. Now, let me tell you about the third one. Suppose we are in a world where there is no inflation. Okay, suppose you are in a world where there is no inflation. Now, you are in school now. You are in the university, right? You are all in the university, isn't it? Good prospects. When you start working, you're going to make money. Suppose I come to you and I say, hey, I want to give you $100 now, or I'll give it to you 5 years after. You'll tell me that, give it to me now. And the reason is not necessarily because of inflation. Because you see, in 5 years' time, you will start working. When you start work, you are earning your own money. So it won't mean much to you if I give you that $100 and that the condition that you are working or giving it to you is school. You prefer taking it in school. You put more value on it. when you take it in school than when you take it while working. Because while working, if I come to you, a big guy, I give you $100, it's nothing to you. But in school, it means so much to you. So the satisfaction you gain from the $100, taking it now, is harder than the satisfaction you gain when I give it to you 5 years time. Okay. Now, this scenario can also be applied in this way. If in a country we expect the future to, or we expect the economy to boom over a short to medium term, what will people do? Will they spend their money now, or they'll save it with the bank? When they expect the future to be great, what do you think they are likely to do? Guy, let me hear from you. Team Cape Coast, let me hear from you. Would they spend the money now, or do you prefer to put it in the bank or invest it? What do you think they would do? Would they invest it or spend it now? If they expect the economy to boom, what do you think they are likely to do? Team Cape Coast, let me hear from you. Quickly, guys. We don't have much time. What do you think they're likely to do?
They will invest it now.
Let me hear that again.
They will invest it now rather than
Yeah, your voice is fainting. I don't know. I think there's problem with your connection. If I should tell, I'm struggling to get you. I don't know if others have same difficulty. Okay, let's hear Team Ashesi. Team Ashesi. What will you do? Will you invest the money or you consume it now? If you expect the economy to be great, the future, what will you do? Team Ashesi. Okay, let me hear from Team KNUST. Okay, Emmanuel, are you coming from University of Cape Coast? Let me know. Team Ashesi.
Yeah, invest it now.
Invest it now. Team Legon. Let me pick your thought. Team Legon, let me pick your thought. KNUST.
Okay, so we'll invest it now, in hopes that it grows along with the boom we expect in the future.
Okay, Team UPSA.
Invest it now. Because
you are all
just
wrong.
like listen,
You're wrong. You're wrong. You see, let me tell you the whole thing here. If I expect the future to be great, I'll value current consumption. So I'll value current consumption. Because look, the future is going to be great, guys. Let's enjoy now. We don't need to worry ourselves about the future. We don't need to go and be investing money towards anything in the future, because future is going to be great. The economy is going to boom. We're all going to have money. The immediate thing that happens to everybody is that you'll start enjoying. In fact, when you're in school and you hear that your mother or your parents will be coming to visit you over the weekend and they are bringing some foodstuffs, what happens to the foodstuffs you currently have? Consume them. Now you don't manage them again. Weekend, people are going to be here. Or somebody promises you money. Hey, and you have some money now. And the person tells you, I'm going to give you money tomorrow. Wow. You consume what you currently have today. That's the usual thing that happens, right? Because the future is good. You value current consumption. But you see, what I want to tell you about that is this. Think about it. Because you value current consumption, if anyone comes to you and say, hey, Daniel, don't consume this money now. Give it to me. Loan it to me. I'll pay you back in the future. Think about it carefully, guys. If anyone comes to Daniel and say, Daniel, yes, the economy is expected to boom, but don't consume what you currently have today. I know you value current consumption. Rather, give it to me. I'll give it back to you in 2 years' time. Perhaps that time the economy has boomed. Daniel, you see, what you are going to do is that you know that in 2 years' time, the same amount of satisfaction you would have enjoyed from consuming that resource today will be more than the one you enjoy if you consume it in the future. So you're actually going to be losing. Daniel will lose by giving the money to so and so. Daniel is going to lose if you end up lending the money. Daniel will lose. Because when the guy finally brings the money to, you lend out the $100. When the $100 finally get brought to Daniel, what Daniel could do with the $100, or if I say what you would do, that will bring in the inflation argument. But put inflation, I said there's no inflation. Daniel could still buy the same quantity of goods you want to buy, but the satisfaction Daniel will get will be lower than the satisfaction Daniel will get today if Daniel end up consuming that money. Because by then, Daniel might have been a rich guy. So $100 mean nothing to you. You don't value it much. It has nothing to do with inflation. So do you know what Daniel is going to say? Daniel will say, hey, guy, if you are taking this money from me, when you are coming back, I want you not to just give me that money. I want you to pay something in addition. Don't just bring me $100. Give me $100 and something, plus something. And that something should be added so that the satisfaction you are losing, you could restore it back. Okay? Because when I give you $100 and you bring me back the same $100, and I consume, I realize that the satisfaction will be lower when you bring it back. So add something to it so that I can get the same level of satisfaction I would have enjoyed today. And that additional thing that have to be done is called what? What's the additional thing that have to be added? What's the name for it? Who can tell me? Who can tell me what it is? Hello, guys.
Yeah, please. Rick's premium.
You are close. You are correct, but not entirely. What's the additional thing? Interest from Enoch. Emmanuel said it first. Israel said what? Oh, very true. I will consume all my provisions. Good. So Emmanuel said interest. Enoch said interest. You are right. That's interest rates. So that's the basis of the interest rates independent of inflation. And we call it the real risk-free rates. Because there's no inflation here. It's all built around utility theory. And the approach I've used now on this time value of money is called the consumer preference. You can read about it, consumer preference. Now, so that is the reason why. So don't always think we call it interest when we use discount rate or interest rate. When we talk about interest rate, it's always inflation. No. There's a base to it. Then inflation is the additional thing we have. Then we add risk premium now. So we add inflation too is a risk premium. Trust me. We call it the inflation risk premium, right? Get added, then other risk premium get added to the interest rate or to the real risk-free rate, trust me. So when you add inflation to real risk-free rate, you get the nominal risk-free rate, right? Now let's move quickly, guys. I'm taking my time to explain some of these things to you because these are fundamental things we're doing. Now, there's some basic propositions in valuation. Proposition 1, for a business to have value, its expected cash flow must be positive sometime over its life. Because here what I've been trying to tell is that on the previous slide was that we put value based, or the value we put based on a benefit. So if I expect some benefit in the future, I need to express all those benefits in the same time index. Like, what is the value of all the future benefits I intend to gain from so and so today? So if I go and buy the stocks of Asante Gold, I ask myself, what is the value of Asante Gold? And I'll say, well, the true value of Asante Gold is the value today, or the present value of all the benefits I'll get from Asante Gold by owning their shares. And these benefits include dividend repayments, right? Dividend payments, right? So if you pay me dividend, or if I end up selling the shares in the future, these are all part of the benefits, right? So I discount everything back. I calculate their value today, and that gives me the value of the shares. If I've estimated the dividend over the life of the period, of the holding period, if I say holding period, that's the period over which I intend to hold the shares before I sell it, right? If I estimate the dividend I could receive from Asante Gold over the holding period, and I don't discount it, then I'm wrong, because 5 cedi today is different from 5 cedis tomorrow. I need to express all of those cash flows in the same time index. So it means that I need to be able to calculate the value of 5 cedi in the future today. And I explained to you the basis. That's time value of money. We don't explain at length. Now, so we are saying that for a business to have a value, or for the value to be positive, if I value a business and the value is positive, for that to happen, then there must be some positive cash flow sometime over the life of the business. Now, that's a proposition one. Because if there's no positive cash flow estimated over life, you get a negative value. And by definition, we don't have negative, stocks don't trade at negative value. And that's why when you study statistics, also, you see that the distribution of stock, the stock prices is considered log normal, is bounded at 0. Right? Proposition 2 says that the businesses that generate cash flows early in their life will be worth more than those that generate cash flow later in their life. All other things being equal, all this is trying to say is that the earlier the cash flows, the higher the value of the business, valuation of the business is going to be, because of time value of money again. Good. Let's move on. Now, this is a very important slide I want to show you. And guys, valuation is not what you think. And I'm going to disrupt your mind today on a lot of things. But don't be confused. We have limited time here. If after this lecture you have difficulty, you can always consult me. I'm not going to help you to put together your thing, but I can provide explanations. You can reach out to me on LinkedIn, possibly. I want to say something here. Whatever I'm going to do, I'm going to distract your mind. So you are going to unlearn some things and relearn some things. Whenever we're doing valuation of any business, including mining businesses, we are interested in the market value. The intrinsic value I mentioned to you may not be necessarily equal to the market value, but we expect that over time there should be that alignment to market value. Okay. Now, so we are looking for market value. So when I take the balance sheet of a company, then the values done on the balance sheet are not at market value. They are at book value. Even though there are some items on the balance sheet that are at fair value. If you take a typical mining company's balance sheet, the items there are at book value. You see, if you take their PPEs, that are really huge, the machines they have and all that, is the historical cost less accumulated depreciation. Yeah, over time, there could be revaluation and all that. Yeah, there are some items there to maybe on fair value, at fair value, like the mining deposit, the fair value of the mining deposit. Okay, so they revalue the deposit over time. And that is repeated or reported on the balance sheet. That may be at fair value. But a lot of items are not at fair value. Now, let's take the balance sheet of a company. I want us to think about something. often when you take a balance sheet of a typical company, you see the assets, you see the equity, and you see the liability. So we know the asset must be equal to equity plus liability. Now, listen carefully. To the left of the balance sheet, we have existing assets and growth assets. Existing assets includes the fees assets and working capital investment that were made in the past. So when you take the balance sheet of a typical company, you see assets, the existing ones. And then going forward, the additional investment the company is going to be making in fees assets and working capital, those are considered growth assets. So we have the existing assets and we have growth assets. Now, the value of the business is going to be driven by these two categories of assets, the existing assets and the growth assets. And don't forget again, assets is a matter of the fees asset and the working capital. So we are going to be looking at cash flows that will be generated from the existing asset and cash flow that will be generated from any growth assets the company will be investing in. If you could recall, I told you 3 items that determine value of a business. I said cash flow, growth. So I said cash flow, that's it. Cash flow, existing asset, growth, and the last one is risk. So I'm showing these things to you. The existing asset is generating a cash flow, existing cash flow, and any potential growth in those cash flow are attributable to growth assets. Are we following, please? Are we following? Is everyone following here? Let me hear you. Let me hear you. Is everyone following?
Please. Yes.
Good.
Yes,
Now, so this is the asset driving growth. So when you're doing valuation, you are trying to look for, hey, all the cash flows are rising from this existing asset, and then maybe you have to also consider if the business makes additional investment, what will be the cash flow potential? Now, but then you should know that the additional asset, you should know when they will translate into cash flow. They may not translate immediately. When a mining company has gone to buy a new site or mineral deposit or discover one, they may not start mining it right away. You need to understand when the mining starts, and that will determine when the cash will start. And usually it's a function of market prices of gold on the market or the minerals on the market. And sometimes use the futures price to infer those prices, how the market price dynamics will be. Use the futures price on the futures stock, futures market. Or I mean the derivative market. You can use the futures price to infer. And that gives them some hope. Or they can get into a futures contract to supply gold at a particular time in the future. And if the market price is good for them, the futures price is good for them, they can go ahead and mine. So the fact that they've bought or added additional mine doesn't mean that they should start quickly. You start translating that into cash flow. No. Now, so the left side of the balance sheet, which is the asset side, is the cash flow side. Guys, is the cash flow side. But look at it. In traditional accounting, we take the asset with the left side and we say that the asset at the left side is being financed by the right side. The right side is financing the left side. Or in other words, the value of these assets were financed by the equity and the liability. All that means is that the equity and the liability and the asset must always be in balance, because the total value of the assets is reflected by the invest or the equity and liability used to finance it. Now, that is a traditional accounting. When we come to finance, we say that these assets are generating cash flows. And the risk associated with those cash flows are reflected in this side, the equity and liability. In other words, the risks associated with the cash flows are reflected in how the asset generating the cash flow have been financed, or how the cash flow pattern, right? The variability in the cash flows the movement in the cash flow, the nature of the cash flow, the characteristics of the cash flows are driven by the right side. Okay. Now, so if we are trying to put a value on the cash flows, or in other words, if we are trying to put a value on the assets, how we do it in finance is that the value of the asset is the value we put on the cash flows generated by the assets. So the value of the asset in accounting, the value of the asset is the value of the balance sheet. That's the historical cause. But in finance here, what we're talking about, the value of the asset is actually the value we put on the cash flow today. Or in other words, the value we are putting on the cash flow the asset can generate in today's term, or the present value of the cash flow the asset can depend. Or in other words, the value depends on the cash flow the asset can generate. In that case, if the cash flow generates no, if the asset generates no cash, the asset has no value. Okay. Then how much does it cost to buy this asset that generates the cash flow? That is the right side. The equity and the liability is the cost of the asset. How much the asset costs to buy. The asset that is generating the cash flow cost to buy is that. Therefore, the cash flow generated by the asset must be able to compensate for the cost of the asset. Now, that's landing us somewhere. That's landing us somewhere. In that case, it tells us that the equity and the liability here must be compensated for. There's a cost associated to it. For us to say the business is generating value, the cash flows here is generating must compensate for the cost of getting the money to finance the asset. Any extra money, the extra money left is what we consider the value. Let's move. This I've shown to you is usually when we are valuing, like I've tried to summarize the entire valuation spectrum for you. When I'm valuing the entire business, that's what I've described to you. If I'm valuing this entire business, I take the cash flows from the entire business, and then I compensate for the cost of financing the assets. And that's which we have a beautiful name for. We call it the weighted average cost of capital. Now, so when I get the asset, when I take the cash flow from assets alone, and I discount them at the weighted average cost of capital, I give you a valuation for the entire business, including the value of the liabilities. Guys, the value of the liabilities. So here, when I value the asset, when I say I value the asset, I'm getting a market value of the asset. The market value of the asset is the sum of the market value of equity and the market value of debt, or market value of the liability. Going forward, I'm not going to call it liability. I'm going to say the market value of debt. So market value of the asset is equal to the market value of the equity plus the market value of debt. And the market value of the asset is depending on the cash flow from the assets. And the cash flow could be from existing asset or from a growth asset. Now, when I want to determine the market value of the firm or of the asset, it's a matter of getting a cash flow from the asset and discounting them at the weighted average cost of capital. Why? Because the asset is financed by both debt and equity combined. So you could see that we have something called market value of debt. Perhaps that never occurred to you before, but we have it. Market value of debt. And we need to determine it. Now, There's another way we can do it. Because at the end of the day, for our work, what we're doing, we want to determine the market value of equity. So that market value of debt have to be determined if we are using an approach where we need to determine the value of the firm, okay, and discount at the WACC. We can choose not to do that. We can rather say we want to determine the value of the assets. Okay, sorry, let me go back to where I was. We can choose to say we want to determine the value of the assets, and then, or we can choose to say we want to get a cash flow that is not entirely for just the assets, but a cash flow for assets minus liabilities. In other words, instead of us determining cash flow for only asset and discounting it at the WACC, we can determine the cash flows associated with assets minus liability. And then we value the residual cash flow now to arrive at equity. You see, if you see the first method, we take the total assets, we value it, which means we value the cash flow generated by the asset and discount all the cash flow at the cost of capital, weighted average cost of capital. By here, we can choose to do it this way. We will determine the cash flow from the asset, but also cash flow associated with the liability or the debt, and then take out adjust the cash flow of the asset by that of the liability or that of the debt. Then that net cash flow, we discount it at the cost of equity, right? And that gives us the value of equity, intrinsic value of equity. And that is what I like. That is what I like doing, because I don't want to go to the trouble of determining the market value of debt. Because if I've gone through the first approach, I'll determine the cash flow associated with the entire firm, discount it at WACC, and then go and subtract the market value of debt from the value of the firm. That's a whole lot of work. Good. But this is the point. Whichever method you use, you must arrive at the same value of equity. That is where the thing gets messy. Because if I use this approach, I must arrive and, if I use this approach, what I do is that I determine the value of the entire firm, which is the value of the assets, right? And I subtract the market value of debt. And then I get the market value of equity. If I use this particular approach, I get a cash flows from the asset. I take out the cash flows associated with debt. And then I discount that net cash flow now at cost of equity. And that gives me the value of equity. I must get the same value. If I don't get the same value, then I have a problem. Many people don't think about it like that. Okay. Now, so as I mentioned earlier, when we take the assets, and so when we say assets, this is still the balance sheet. I'll call it the balance sheet in finance or finance balance sheet. No, this is not accounting balance sheet. This is finance balance sheet or valuation balance sheet, guys. Valuation balance sheet. If I take the asset side here, I'm looking at the cash flows generated by the operating assets of the firm. Then we adjust that for working capital investment and keepers. And don't forget, because I told you that we are looking at additional investment the company will make and the cash flow will generate. So the cash flow generated from the asset is from both existing and additional investment. So it makes sense to adjust for additional investment you want to make in fixed assets and also working capital. So that's what we have here. So both existing and growth assets contribute to cash flow. We have that. Then, since this is the cash flow from the entire firm, I'm just rehashing the same point, summarizing it. Since this is the cash flow from the same entire firm, for the entire firm, I mean, from the asset holistically, and the asset is financed by both equity and debt, then we need to discount these cash flows at a discount rate that reflects the structure or the character of the financing, which is the fact that the company is financing this by both equity and debt. So we are discounting the cash flows at this rate. That's what first thing I talk about. Then I went ahead to talk about that of the equity. That another way to do it is to rather move the debt to the left side. So look at what is happening here. The cash flow from the asset after adjusting for, now we are adjusting for net debt payment. And after making reinvestment needed in operating asset and working capital. for the future. So now, in the one where we are doing the valuation from the entire company point of view, we didn't adjust for net debt payment. But here we need to do that. The whatsoever cash that is left is then discounted at cost of equity. Any questions so far, guys? I want to hear from you. I'm setting the ground rules. You have to start thinking about valuation in a different way. Any question? Are we all okay? Let me hear from everyone. Please unmute yourself. I need to hear from you. Are we all okay?
Yes,
I want
yes,
to know
please,
that.
you're okay. Yeah.
Yes, please.
Are you enjoying me? Are you enjoying my lecture? Or you guys,
Yeah.
am I sounding bored? Are you learning something new?
Oh, yes, we are.
Yes,
We
please,
are
you're learning
enjoying the
something.
lecture.
Good. Great. I'm happy you are enjoying this. Now, so all I described to you is just approach to arriving at some intrinsic value. But what are then the models? I kept talking about cash flow. What do I really mean? Because there are several ways to arriving at that thing. And there are various methods to estimating this intrinsic value. One is the free cash flow model. Think about it. They say the cash flow is free. Free cash flow. It means that I have generated some money from my operations. I've made provision down for reinvestment, which otherwise people call plowback profit. I made provision about how much I can plow back into fixed asset, into working capital. And then even after spending all those things, I still have some money left. That is what we call a free cash flow. That's a free cash flow. The money is free. It's freely available. There's no demand on it. I've made provision for how much I want to reinvest. I've made 1 million. I've made 1 million as a cash flow. And then, I made some provision for next year. I need to buy some assets to add to the existing fleet of whatever. And I need to make provision for working capital. And all that costs about 30 million. I take it out of the 100 million. Is that what is left? For me, 70 million, that becomes the free cash flow. That's the cash flow freely available to me. Guys, this is simple. Free cash flow. Residual income is even simpler. And I'm not sure you've seen this method before in your investing. We didn't see. Just few of us use these methods in the country. Trust me. Don't take my word for it, right? Now, then a discounted cash flow, a dividend discounted model. I believe you've seen this one before. Now, this is the point. When you use the free cash flow model, the output from the valuation may either be the market value of the entire firm or the market value of only equity. If it is the market value of the entire firm, then you need to take out the market value of debt out of it to get the market value of equity. Let me repeat again. If you get a market value of the entire firm, which often we call enterprise value, when you get that, you need to take out the market value of equity. Oh, sorry, market value of debt before you arrive at the market value of equity. That's what you estimate ultimately looking out for. So the free cash flow can either give you both. And what I mean by can give you both is that it depends on the type of free cash flow you are using. If you are using free cash flow to equity, the valuation at the end of the day, you arrive at equity value because you got to be discounting that at the cost of equity. But if you are using free cash flow to the firm, the entire firm, then the valuation is going to be for the entire firm, right? And you are going to be discounting that at the weighted average cost of capital. Now, when you do residual income model, guys, it is entirely equity value. You don't have to worry, it's equity value. If you do dividend discounted model, it's entirely equity value you're arriving at. And that's what you're looking for, right? Let's see, 1 over. If really, it looks like these are shared or no, it's not going to be working. If you think about it, be that I'm trying to summarize things today, I'm even having challenges. Hi, Free, are you there? I think there's another statement. I'm trying to see how quickly I can wrap up this and I get some question.
Yeah.
But there may be the one speaking, I think. Okay. Now, of course, the free cash flow and things, you guys can read a lot about it, right? Now, what's have I heard about the residual income model before? Okay. Now, so I put in these models here, and I think they'll share this with you actually. You'll see the formula I put in there. And of course, when you come to this sign, you know what it means. I try to, when I use mathematical languages, it's easier to write a lot of things I would have written if I would have found difficult to write if I'm to use writing words or something. So mathematics just help me in many cases just to put this thing. The next session starts 2:30. I'm happy. Just that my people here will start claiming that they have to go for lunch. Meanwhile, I've not taken lunch myself. Who is there trying to say you want to go for lunch? I know nobody's saying, but I'm just trying to attack somebody unnecessarily. Good. Let's continue. Now, so if you have something here like this, it means this sign here, in mathematics means for all i's greater or equal to 0. I think you can make some great meaning out of it. My concern is not really getting into some of these interesting cases. Just a moment, guys. Guys, sorry for that. Now, maybe let me talk to you a little about residual income model. And then, this will help you when you start thinking about valuation. When someone comes to you and say, oh, I'm trying to value a business. I want to see whether a business is worth it or not. Look, if I go to management of any company, I tell them that, look, I expect a certain return from you. If you can hit that return for me, I'll put a higher value on your business. If you fail to meet that minimum return for me, I'm going to take my money out, or I will have to sell your shares out. If you consistently fail to meet a certain minimum return for me, I'm in trouble. So I go to management. I say, let's get a deal done. I expect 12% return when I buy your shares. And their report is showing that they can give me 15% return. Wow. What do you think I'm likely to do? If I expect, based on all my computation, I expect 12% return, and somebody is willing to give me 15% return, won't I be happy? Or shouldn't I be happy, guys? Hello, guys.
Yeah, you should.
It's raining here. The rain wants to embarrass me. I'm moving to another location, another part, so that I don't have the noise coming. Right. I'll be happy if somebody comes to me that, please, guys, am I still audible?
Yes, we can hear you.
Good. So if someone comes to me and say, hey, Julius, I'm going to give you 15%, but you want 12%, what I'm going to do is that I'm going to put more value on that company's shares. Because I'm happy. They are giving me more than what I expect from them. Okay. Now, this is the catch. If I go to the same company and I ask them that I'm looking for 12%, and they're saying that they can only give me 9%, will I put a premium on their shares? I'm sure the obvious answer is no, right? I won't put a premium on their shares. But what if I go to them and I say, I want 12%, and they are giving exactly 12%? They are just meeting the needs, right? They are giving exactly what I expect, isn't it? This is the point, guys. Let's look at an analysis here. And I want you to follow me. Let me open my Excel and let me show you something on these matters. And so let me share my screen again. these people shouldn't take my lights because I'll be in a serious trouble if that is done to me. Data, let me try to, let me go to view so I can take off the grid lines. Sometimes this just get hidden somewhere. I think if I go to review rather, sometimes I misplace. I fail to actually know where it's located when I'm using Mac. Page layouts, I think. Yeah, good. Take off my grid line. Now let's look at it this way. Let's talk about ABC Limited, right? And follow me. The company is starting the business with an initial equity of, so I'll call it equity initial, right? I want you to get the thought behind why we use that methodology. I don't like reading from textbook and considering myself as expert in it. No. Let's say the company is starting the business with initial value of equity of 1,000. Okay, 1,000, whatever. Now, what the company always promises me is in the form of what you call return on equity. That is what they promise. We measure it in return on equity. The return they intend to make on equity. All right. Now, let's put that as 20%. So what it means is that in 5 years' time, if this return of equity of 20% is made every year, in 5 years' time, in 5 years, I want to see this 1,000 multiplied by 1 plus 20%. Guys, can you guys still hear me? Because it's raining heavily here.
Yes, please. I can hear you.
I'm very audible, right?
Yes,
Okay.
you are.
Yes, sir.
Yeah, good. So in 5 years' time, so let me grow this to 5. So to the power 5, right? So let me put, in 5 years' time, the value of I'll be getting should be this. In fact, this should be the value of equity on their balance sheet in 5 years' time. The total book value of equity should be this amount. Okay. So that if I go to the balance sheet, equity book value, BV, should be this amount in 5 years' time. All right. Now, let me add a caveat. You know, Ghana often we know our tradition is that once it start raining, we off lights. So, in case you stop hearing me, my light is off, and my phone hotspot is not advisable, but I'll try and join on another laptop. So, I may be off for a while and then join again. I have an inbuilt internet on another laptop I can use. So in case the light is out, don't lose hope. I'll join, but on another laptop. Okay. Now, so that is the book value in 5 years' time. If what the return I also expect, which I'll call expected return, okay, if my expected return, if my expected return is also 20%, then we are in business. It tells me that in the same 5 years' time, I invested 1,000. In the same 5 years' time, I should get the same value of 2,488. Okay. Now, so let me copy the formula and insert it here. So I'll call this the market value, equity market value. So I'll get the same value in 5 years' time. Let me ensure that I think I need to put the return on equities for the book value and the market value expected return. An expected return is the cost of equity, guys. Okay. So I'll get the same value in 5 years' time when we start a business. Because I expected 20% from management, and management is delivering on the same 20%. So we are fine. It tells me that if I go to the balance sheet, the book value of equity is the same as whatsoever I should be expecting on the stock market. You know, I told you earlier that the book value of equity or the value on the balance sheet may not be reflective of market value. However, in this case, I'm saying that if the return on equity the firm promises me is the same as the cost of equity I have calculated, which is my minimum return I calculated, if the two are the same, let's say we've constant over the next 5 years, the market price of the share shouldn't be different from the value of the book or the book value of the stock price. The book value of equity. That is the value of equity on the balance sheet. If it differs, then it may mean that either the market price is or the stock on the market is undervalued or overvalued. I want you to get that. Now, if rather the firm promises to give me a return on equity of 15%, look at what's happening. They promise to give a return on equity of 15%, but I'm expecting 20%. What it means is that I will be overpricing this company at this rate. And this is the value they will be getting. Based on the book value, this is the value the company promises to be giving me. In 5 years' time, this should be the value of the company. And then in 5 years' time, if I'm basing it on what I'm expecting, this should be the value of the company. That won't be proper. So if I expect a lower return from them, I need to put a lower value on the company. In other words, I'm expecting 2488 as my investment in 5 years' time, but they said they can only deliver 211. So I'm going to put a lower valuation on the company. That's a residual income model, trying to say. When I get into the details, you'll see it soon. What is trying to say in detail. Here, I was just giving a synopsis of the residual income model. Okay. Let me stop sharing. And the rain has stopped, right? It's only in Ghana that rain can just come and distract and go, and nobody will see anything. Now, these things are placed there here are mathematical, so I'm going to go into the details so you see things clearer soon. So I just introduced those methodologies for you to see. Now, lesson 3. I have, I think, 4 or 5 lessons today. Let me see. To give on this, I have 5 lessons. So we are now on lesson 3. Okay. Considerations in forecasting cash flows. And now listen carefully. When we are doing cash flow for valuation, and clearly, I want everyone to listen to this because this is one of the most important part of it. When we do forecasting, a financial statement we forecast for valuation purpose may not be the same as the financial purpose statement we forecast for budget purpose or for any strategic investment purpose. For valuation purpose, we are after the market value of the business. Therefore, the assets, the liabilities, and the equity, we must be guided as such. Usually, if I take the financial statement of a typical company, what I'm going to be seeing, or the balance sheet, I'll see the asset, I'll see the liabilities, and I'll see the equity. We are trying to estimate the market value of equity. Depending on the methodology we take, we may be required to estimate the market value of debt. That's if we are trying to use WACC. In fact, before I talk, maybe somebody should tell me how he approaches that. If what you were taught in school, let me hear, then let me see where I can carry it from. If there's any area I need to correct you, I do so. I want to hear from some guys. Please speak. Don't feel free and speak, because so that if there's something you are thinking wrongly, I can correct you. What you are doing is that life doesn't end at the end of the research challenge. It goes beyond that. If you want to develop a good career in finance, it's good you understand these things properly from the one. I didn't understand it when I was in university because nobody taught me. I never had opportunity. So you had an opportunity to have this chat with a practitioner. So I want to hear from you. If you are doing evaluation, often, let's say free cash flow based valuation, how do you handle it? I want to hear from you. How do you do? Let me hear from you and then address the concerns from that side. Who are we starting with? Let's start with Team KNUST. Team KNUST, let me hear from you.
Okay, so I begin by after making my assumptions and forecasting my operating line items, I arrived at net operating profit after tax, and then I add back non-cash expenses like depreciation, amortization, and then I subtract capex and changes in operating working capital to give me free cash flow to the firm. After that, I calculate the firm's terminal value, and then I discount both the free cash flow to the firm and terminal value into today's term. So I arrive at the enterprise value. And then I subtract market value of debt to obtain the equity value. And then I calculate my share price by dividing outstanding shares by the equity value.
Great. Great one. Thank you very much. Now, let me hear from another person, from another from another school. So can we go? University of Ghana have not spoken. Oh. Eugene, you guys are disappointing me. Oh. You want me to feel shy? Eugene, let me hear from you. It seems nobody is on the call from Eugene. Let me hear from Eugene. Eugene people all run away. Ashesi.
Yeah, hello.
Yeah, Ashesi or Eugene? Let me hear.
Ashesi.
Okay, Ashesi, let me hear from you.
Yeah, so it's basically the same thing as he said previously, but for the FCFE, the free cash flow to equity is, I just wanted to add on that it discounted at the return on equity, but the FCFF, you discount it at what? Yeah, that's just what I wanted to add it, but it's just the same thing as what he said previously. Thank you.
You're welcome. Great. Thank you very much. Now, that's a great response. The question I want to ask Team KNUST is, you mentioned that you take out the market value of debt. Of course, that had been the argument I've been making. How do you determine the market value of debt that you take out?
Okay, so I begin by finding all interest bearing liabilities, and then I subtract cash available from it to arrive at the market value of debt.
Okay, thank you. Who has something to say about that? Team Cape Coast. Team Cape Coast. Team Cape Coast, let me hear from you. You know that Team Cape Coast has run away. Okay, Team Academic City. Academic City. Academic City people to have run away. Okay. I'll talk to you about that. That's not it. That's not it. You see, and you are not wrong. You see, that is all this in several textbooks. Several textbooks don't even address this. They just tell you market value of debt. They never explain what market value of debt is and how they derive it. That's the problem we have. They tell you methodologies, but they will never explain the point. And a lot of people don't know this. So you are going to know something that many people don't know. Now, let's start like this. In everything we do, we have some cash flows we are working with. To start the whole process, we start by doing historical earnings analysis or historical trend analysis. So mining firms or housing, but we do historical trend analysis, right? Now, one thing I want you to know is that when you're doing the historical earnings analysis or historical trading, what I mean by historical trading is the history, the P&Ls, right? The historical P&L, the past P&Ls, audited P&Ls of the company. You should be aware that when you are analyzing historical financial statement, they should be analyzed in the context of the firm's historical capacity and macroeconomic conditions prevailing at that time, and also the industry. Very important. Because if I'm taking the P&L and realize that, oh, profit jump at a point, or let's say revenue jump by 80% in history, in a particular year, revenue increased by 80%, then it declined again. Then I say, oh, I'm projecting that in the future, same thing is going to happen. No, you're lying. That's not entirely accurate. And the reason why that's not accurate is that, perhaps there was a discovery of a new mine, or they started mining a new mine, and that has resulted in a jump in revenue. And the year there was a decline, it could be that the market prices were not favorable to do mass mining. So there was a decline in mining and a decline in sales. So you cannot just use history, calculate the year-on-year growth in revenue and average it and say, hey, I'm going to project this for the future. Sometimes you can do that. You can do that, but just to set your model right. From there, then you go back to evaluate assumptions. But the first thing we do is rather to do historical analysis. And we call that historical trading analysis. So you do some form of trend analysis and the growth in revenue, growth in expenses, and all those things, right? Then you have to understand the seasonal and cyclical patterns. And I mentioned one of the seasonal and cyclical patterns. That's why sometimes if you are doing a proper valuation, you often look for monthly financial statements. In some cases, I prefer, when I talk with my clients, I prefer them giving me monthly financial statement in some of these things, because I want to be able to understand the the seasonal nature of the business. The cycles is easier to see from year to year. You can see and all that, right? Now, there may be a need to do those cyclical adjustments, those form of normalization adjustment. Guys, historical analysis is not just like what you guys do in school in terms of if they say do ratio analysis and write a report. It goes beyond that. When we do this in practice, or when you have to do this and do presentation, you may identify with these one-off items and take them out. Okay, so this item is a one-off item. When I take it out and I recalculate the gross margin, how is it like? Okay, so I was doing something on a certain company that was heavily affected by the COVID-19, because the company does a number of contract work at the airport. And then during the COVID-19 time, the airport was closed to about 6 months. So revenue at a point was low over that period. So when I'm looking back to do analysis, I want to use the analysis to do some valuation of the company. So I needed to normalize the historical data. But assuming that, suppose that event was never there, how would the company's performance be like? So I'm doing those normalization adjustments. Identify one-off items, those non-recurring items, and extraordinary items, and adjusting them. You may not have enough data to do that, but if you have the financial statement, read the financial statement properly. In the notes, you may find these nuances where there may be a need for you to adjust. You see, the reason why we need to take these things into consideration is that you don't want to form a wrong conclusion about the future of the company. You don't want to say, oh, based on history, the company is going to perform like this, perform like that. Meanwhile, if you have taken time to adjust all those one-off items, you wouldn't have been forming those conclusions. Okay, so that adjustment is called normalization adjustment. Now, I told you about volatility issues where you realize that maybe revenue is very volatile. You need to investigate for everything you do in the cash flow analysis. You need to investigate from the firm. Why did your cost drop? Why did your revenue rise in a particular year? Why the decline in so and so? Why the rise in so and so? You want to form understanding of it before you then make assumption about how the future will be like. If you don't understand the history, you'll find it difficult to do that. So you have to look at the capacity of the company. Over time, maybe their capacity has changed. And don't forget, some mines may have a useful life of, let's say, 20 years, 30 years, 10 years. So if they are mining a certain site, you need to understand whether at a point another mine was added. That's the reason why revenue has doubled or has increased significantly. Or maybe a mine has come to, a mine has been fully mined, right? And because of that, the revenue from there has been truncated. There's no more revenue coming from there. So that's why there's a drop in revenue in a certain year. Okay, so the cash generating asset here has to do with the mine. And the useful life of the mine affects historical records as well. So then with this, you can actually come up with some basis of projecting for projecting cash flows. One thing is that when you are also doing projections, you need to look at the existing mines. What is their useful life? Okay, so if you are doing your projection over 5 years, and some of these mines, or almost all the mines, have useful life or expected useful life exceeding 5 years, then you are safe. But you are not entirely safe. You are not entirely safe because when you come to the terminal value, you are going to assume that someone may make an assumption that, oh, the so and so cash flow at the terminal value is going to continue indefinitely. And that assumption may easily be shut down by panelists because they will ask you that, okay, the mines they currently have, what's their useful life? If their useful life is less than 10 years, and you have done your cash flow projection over 5 years, and then you said the cash flow you've gotten in the 5th year is going to continue indefinitely, you are in trouble. Unless you can demonstrate that new mines are underway and they'll still start exploring those mines. If that argument can be made, then we can say that cash flow will even extend beyond. Because some mines, maybe they may fold up right after the last mine they've done, or maybe they've acquired a new mine that they may not mine now. They are still doing prospecting and all that. There will be a time for prospecting before the actual mining starts. So all those have to be factored into your cash flows for you to know when the cash flow will actually start coming in. Okay. Now, I told you about normalization of cash flow. I said a lot about it already. But then you are removing, I mentioned extraordinary items. If there are changes in accounting standards over time, of course, maybe they have been adopting the cost approach for a certain asset, and then that asset got revalued or something, or the depreciation model, or how do you call it, the cost model, and then there's a change in those kind of accounting methodologies, or the inventory method that they use to value inventory, maybe FIFO, and then over time they use average cost to value some of these industry inventories. Then that brings some form of difference. So there may be a need for a rectification. So you want to normalize it. What you are trying to do is that suppose over the historical period, they have entirely been using the current method they are currently using, maybe average cost. What would have been inventory valuation? I talk about non-recurring event. One of maybe there was an acquisition, or maybe they issued some capital on the stock market and they incur some expenses in the issuance, and that expenses get sent to P&L account, you need to adjust for those things because those things will not continue happening. So those non-recurring items must be addressed. Now, the next thing, we also address changes in capital structure. Think about it this way. When you are want to do evaluation today, you are not concerned about the historical capital structure. In other words, the mix of equity and debt they've been taking on historically. You are looking at now into the future. What is the structure of capital going forward, not historical? You are looking at structure of the capital structure going forward. So if the historical financial statements are impacted in any way by the historical capital structure, then those financial statements historically must be adjusted. And there's a reason for that. Because of that, if somebody has gone to take loan, the company has gone to take loan to buy some mining asset, let's say 3 years ago, they've taken a loan, let's say $50 million at 10% interest rate. As at the time of valuation, you are left with 30 million to be paid at the same 10% interest rate. Ladies and gentlemen, that value of debt is not the market value, it's the book value. You need to calculate the market value of the loan before you use it. Now, what it means also is that the interest expense must be based on the market value of the debt, not the book value of the debt. However, the actual interest paid is based on the book value, but the interest expense must be based on the market value. So if a company takes a loan or has taken a loan 3 years ago and is left with 30 million to pay, that is the book value. We don't use it for valuation. We need to estimate the market value of the loan to be paid, left to be paid. And that is what we use for valuation as the market value of debt. And also the interest expense that goes into your projection must be based on that market value of debt, not the book value, which is the book value, the amount left. A lot of people make mistake in this, and they do it wrongly. They always use the book value. That's why I asked, and I'm also glad that Team KNUST brought that up. Okay. Now, you also have to factor in our management decision going forward, what management wants to do, the changes management wants to do. And this usually is through an interview with management to ask them questions on what they intend to do. Okay, good. Let's move on. I'm almost wrapping up, right? Now, I'm still on consideration in forecasting cash flow. See the same thing in forecasting cash flow here. So the valuation date is very critical. We need to know what the valuation date is. What's your valuation date? Do you know the valuation date, guys? What valuation date are you guys using for the valuation work? Hello, guys. I want to hear from you. What valuation date are you using? I want to ensure am I audible?
Yes, sir.
Okay, I want to know what's the valuation date. Come on, talk. If in any way something we need to clarify, we do that now. What's the valuation date? What valuation date are you guys using? On what date are you doing the valuation? Do you all have any idea of what valuation date? Do you know what a valuation date is? Anyone who doesn't know what valuation date is, please speak. Let me hear. Just go
Sir,
ahead and
please, I
tell.
don't know.
You said?
I don't know what the evaluation date is.
Okay, but do you know what a valuation date is? No, guys, speak. Speak so that you make a good impression of yourself. Because I'm here to help you. Do you? Okay, so The valuation date is the date on which we are doing the valuation. Are we doing the valuation? Are we looking at the value of Asante Gold as of today? Okay, today. Today is November 16. On November 16, Asante Gold is worth so and so. Okay. On November 16, Asante Gold is the value of Asante Gold on November 16 is so and so. So that's what I mean by valuation date. On what date are we doing the valuation? Guys, 5 seconds, please. Guys, sorry. Now, so what I'm trying to say is that Asante Gold's financial statement date may be December 31, and that may not be the valuation date. You may not be interested in determining the value of Asante Gold on December 31, 2023. No, it's even far way back in the past. Do you really care about that? You may not really care about that. You may be looking at the value of Asante Gold on 31st October 2024. You see, when things happen like that, they create some difficulty, and that's and you know, a lot of people, what they do is that they still refer to the date on which the financial statement was prepared. So that is 31st December of the year, and they use that as the valuation date. We don't do it like that often. We can determine the value of any company at any point in time. And that is where I'm going to show you another thing that will distract your mind. Will help you to think. When we're doing valuation, will help you to think like a pro in valuation. That is this. Let's follow. The valuation date may not be the reporting date. That's the financial statement date. Whatever the valuation date is, you need to construct a 12-month trailing historical trading for the company, which could form basis for projection. Well, this could be a bit some way difficult for you, but let's look at it. Whatever the valuation date is, you need to construct a 12-month trailing historical trading for the company, which could form basis for projection. What I'm trying to say is this. We are going to make an assumption right now so I can make a point. Suppose you have the monthly financial statement of Asante Gold. And if you happen to be, maybe today's date happen to be 31st December. Do you know if you have the monthly P&L, you can construct the P&L for the entire year by summing up the last 12 months? Is that okay? We can do that. We are currently on 31st December 2023. We can look back 12 months and sum the P&Ls for the 12 months. So revenue for every month summed together for the last 12 months. Then that gives the annual revenue. If that can be done, it means that if we happen also to be on maybe 31st January 2024, we can still look 12 months back and sum up the P&L of the company for the last 12 months and still get a 12-month financial statement. If we happen to be in February, we can look back 12 months and sum up the revenue, the core. You know, we can construct a 12-month P&L with the February being the reporting date. If you are in March, you can look 12 months back. So 12 months back in March will be from last year, April, right, to this year's March. You can look 12 months back and sum up the financial statement. Okay, you look 12 months back and sum up the financial statement to get the annual version. So you can always reconstruct the P&L by looking 12 months back. That is if you have the monthly financial statement. In fact, even if you don't have monthly, you have the quarterly financial statement. Listen, guys, the quarterly financial statement. And you can always look back 4 quarters. Okay, you look 4 quarters back and reconstruct the P&L. So, for example, even if the reporting date of Asante Gold is December 31, I can look 4 quarters back and have the same 12 months constructed. That will include the quarter ending October, which is quarter 3, then quarter 2, quarter 1, and last year, quarter 4. That gives me 4 quarters. So you are going to do this historically. Guys, listen carefully. You will reconstruct the history back. So such that the reporting date of your financial statement will now be reconstructed back to have the valuation date as the reporting date. So if the valuation date is October 31, I think let me take back a statement I make that you look at 4 quarters back starting from 31st October. No, quarters ends 30th September. I'm sorry. Now, you are now reconstructing the past financial statement to reflect a new reporting date, which is the reporting date or which is the valuation date. Okay. Now, let's look at what I'm trying to say here. Now, so look on the screen. You have previous reporting date, which is December 31, 2022. So let's just say the last reporting date was 2022, the previous reporting date, I'm sorry. Then the valuation date for Asante Gold, let's say, is September 30th, 2023. That's the date on which they want you to estimate the value. Like, what is the value on so and so date, right? September 30th. I think the panel wants you to determine this on your own. So you can choose a valuation date, a recent valuation date. So September 30th, 2023 is the valuation date. Meanwhile, the next reporting date was in December 31, 2023. Forgive me, I didn't change this date because the time I created this slide, this particular slide purposely to train my team at work, right? So the previous reporting date is December 31, 2022. Then the valuation date is September 30th, 2023. And the next reporting date happened to be December 31, 2023. So you see that the previous accounting reporting date was 2022. And in the course of the year, we wanted to value the business. And in fact, we are valuing it on the date September 30th, 2023. But we know the next reporting date, 2023. Let me tell you how some people do. Some people rather go and negotiate that they want to do the valuation on 31st December 2022 because they know they have the financial statements at that time. Now, often for most companies, they have quarterly reports, and Asante Gold should have because they are listed on the stock market, foreign stock market. So they have quarterly report. So you'll be able to get the management account, the unaudited management account up to September. Good. So you can actually, then they can just use that as basis. But some people don't do that. Some people go and say, hey, September 30th and December, there's no much difference. So let's do the valuation on December 31 because they feel like they want to be comfortable. They will get the next report financial statement. That's not proper. Now, the proper thing is that the reason why we do this thing is that we want to reconstruct the historical financial statement. You reconstruct the historical financial statement to rather end at September 30th instead of December 31st. So historically, the financial statement had always been December 31. I mean the P&Ls. I'm talking about P&L now, right? P&L is what you are reconstructing. You have really been getting a financial statement ending around this time. Did I say only P&L? Not necessarily. Some companies also publish their balance sheet, so you can always have the balance sheet. You always have the financial statement ending December 31. But now we want to reconstruct it. Instead of it ending December 31, we want it to end September 30, the valuation date. The reason is that once it ends September 30, we can now do the forecast such that the forecast ends September 30. So you see that the financial statement you are using for your valuation is going to be different from the financial statement that the accountants use. So I brought another thing again. The first thing I brought is that I told you that debt must be expressed in market value, even including bank loans and all those things. And I said that now going forward, the debt we express at market value, the interest expense in the projection must be based on the market value. The second disruption I brought to you is that you need to reconstruct the financial statement such that the forecast of the cash flows over the period for the valuation purpose, the forecast date or the ending of the cash flows or the years you are using should be ending September 30 of each year. That's another disruption I brought to you. Now, when you are doing the forecast of the cash flow, the debts you are forecasting must all be at market value. You are starting it with the market value and continuing in that fashion. Okay. Now, so I demonstrated something with quarters. In case you have quarterly financial statement, you are currently doing the valuation on September 30. Therefore, you look 4 quarters back and sum up the P&Ls, and that gives you revenue for the last 4 quarters. The balance sheet is no more of a problem because it's cumulative in nature, so you can always get the balance sheet value as at a particular point in time. The P&L, you must look 4 quarters back and sum up. That gives you the P&L for the year ended September 30 instead of for the year ended December 31. So now you then forecast the financial statement, forecast financial statement shall then be done on the basis of the last 12-month financial statement. But here I'm talking about last 4 quarters. Because if you don't have monthly financial statement, you have quarterly, you rather based on a quarterly. So the forecast financial statement shall then be done on the basis of the last 12-month financial statement, implying that the company's year end will be assumed to be September 30 for each forecast period instead of the 31st December. Okay, that's a very important thing I mentioned. So you are reconstructing the past. Now, and I said that the forecast then should be based on a year end December or September 30, or that's the valuation date. Good. What then is the forecast? That's what I want to cover now. What then is the forecast? I think we have 6 additional slides, then we are ending the lecture for today. So if we say we want to forecast, over how many periods? Is it 2 years? Hello, Julius. We have 30 minutes more to go. Yeah, good. Yeah. I'm going to complete within that time. If we say we are forecasting, is it over the next? Are we forecasting over the next over the next 2 years, over the next 3 years, over the next 5 years, over the next 10 years? What are we doing? Now, as a matter of general practice, explicit forecast. So that period is what we call the explicit forecast period, right? As a matter of general practice, the explicit forecast period should not exceed 10 years. It shouldn't exceed 10 years. But I see mining and all those things, sometimes, you want to forecast enough period so that it covers a longer time period, especially if as it stands now, they have not commissioned any sites to explore and all that. They are still doing prospecting and all that. You may not want to do 5 years because you want enough and sufficient time that the cash flows will level up. So you may be thinking about 10 years, especially for mining. Now, most analysts do 5 years. So what you need to do is that you want to strike the balance between providing a realistic projection and managing uncertainty. Very important. Because the farther you get into the future, the more uncertain your assumptions become. Now, so some key consideration, you look at the industry and business dynamics. So here, we are very much concerned about we can combine the industry and business dynamic with the macroeconomic factors to think about issues of exchange rates, think about the gold pricing on the market, right? Golds are priced in dollars. So, of course, you are not actually going to concern much about exchange rate, but you are looking at the future gold prices, commodity prices on the market, global market. You are really much concerned about that. And also, you are thinking about the capacity of the company going forward. The existing capacity, the question is whether they're going to increase that capacity. Are they going to explore more sites? Are they prospecting new sites that are they have good of commercial quantity and all that they're going to mine? And what's the quantity to be mined over the period? You are concerned about that as well. Right. Now, so that is the argument on cash flows, forecasting and all that. You see, you thought I'm coming to do SL work and do financial modeling. Now, this session is quite short, so I couldn't get into those things. But I think I've provided you with some guidance on matters like that. There are 2 lessons left. I've done a lot of work on them already, and you already understand a number of things on them. Like the free cash flow, I'm not going to waste time on that because you guys give me some responses which I think are great. So I'll go straight and just look at the terminal value side of the free cash flow. Okay, so when we determine a terminal value, there are multiple approaches to arriving at a terminal value. We have the liquidation value approach, where you assume that when at the terminal value is the period at the end. That's the end of the explicit forecast period. So if I'm forecasting cash flow over 10 years, the explicit forecast period is 10 years. Then you cannot, because the business is going concern, you can say that once you get to that 10 year, the business collapse. No. Or we can say that the business ends entirely. No. Since we are assuming going concern, we need to determine what will be the value of the business as at the time in that 10-year time. And so there are several ways we can handle that. We can assume that, okay, in 10 years time, I want to sell the business for so and so value. That becomes the terminal value. You are going to create that kind of a hypothetical liquidation scenario. Like in 10 years time, I'm selling the business at so and so value. Another way to arrive at the value of the business in that 10-year time is to come up with some market multiples, like price to earnings ratio, price to book. And those are big matters I could have taken my time to go through, but we don't have enough time today. I just have some 2.5 hours to whatever, which isn't quite great for me to get into those things. So I will say that I can share some materials with you guys by tomorrow on the relative valuation approaches. If you have any difficulty, you contact me via my email or you contact me on LinkedIn. Now, another way of getting the value in that 10 years to use the multiple approach, price to earnings, price to book, and all those kind of stuff. So you say that, well, in that 10 years time, let's say our earnings is going to be so and so. I'll just multiply with an average price to earnings, which I can estimate today. An average price to earnings ratio, and that gives me the terminal value. A lot of people actually do, a lot of analysts use that. If you are doing enterprise valuation, several people use the enterprise value to EBITDA ratio. So whatsoever the EBITDA is, you have estimated, you just multiply that by the enterprise value to EBITDA ratio, which is in most markets, if you use Damodaran, you can get these things all trading there. And Damodaran provides these details actually on its side. Now, so that's one you can do. That's when you want to determine the value at that point and using those methods. There's another method to use. And here you are going to assume that the cash flow or the last cash flow you estimated is going to grow indefinitely at a constant rate. Okay, at a constant rate indefinitely beyond the explicit forecast period. And so basically, you're going to treat that last cash flow. Maybe it's a free cash flow. It can be a dividend. It can be a free cash flow. It can be residual income, blah, blah, blah. You're going to treat, I'm sorry, I'm not talking about residual income because I'm still on the free cash flow. But then as a free cash flow, all you got to do is that you just got to take the free cash flow and discount it. You are discounting because you assume that that cash flow is going to be constant. So you are treating it as a perpetuity. Often in practice, what I do is that I take the um I take the long-term GDP growth rate, and that's what I use to do the discounting. Sorry, I take the cost of equity and I subtract the long-term GDP growth rate, because you are trying, it's going to be growing, that cash flow will be growing at a constant rate forever. So you take the cash flow, you divide by the cost of equity minus the long-term GDP growth rate. That's what I do. But this method is actually very suitable for very matured companies. Otherwise, for me, the multiple approach is quite cool. You get a market multiple for similar companies, similar mining firms, and then apply it to whatsoever validity, whether EBITDA or earnings or something at that date, and then discount it back, right? Now, so I spoke a lot about this discounting thing. And so the last session here, I spoke a lot about the residual income model, and the notes will actually be shared with you. So you can have some time to go through this. If you have any difficulty, you can get back to me. I actually want to stop here and get questions from you and answer the question. If some of them will still relate to the residual income model, I'm happy to still provide responses. But I think my notes were explanatory in nature, that they can provide you with good understanding as to what you should be doing. I took my time in writing these notes for you. So let me hear from you if you have any question. I know questions will be on discount rate as to what discount rate should be used. Please ask if you have any question on that, and I'll answer you. So I think I can use that to explain those points to you. Okay, so I'm on my ears, please.
Okay, please use the time for you to unmute yourself and ask your questions.
Yeah, hello.
Yes.
Yeah, please. I have a question regarding the free cash flow value.
A question regarding okay, so hello,
Yes.
let's give them 2 minutes to put their questions together. I think somebody is delivering something to me at the gate. Let me just pick it up.
Right,
So
sure,
2
that's
minutes
fine.
to put their questions together. 2-3 minutes, yeah.
So while we wait for him to get back, you can put your questions in the chat and he'll respond to it. If you have any follow-up on that, then we can take it when he gets back. So kindly put in your questions, and then we'll work around that, because we're going to start the next session around 2:30 on report writing and financial statements analysis, and that will be the last session. So kindly put your questions in the chats while we wait for Julius to get back.
Okay, I'm back now. Thank you for holding. And okay, so the question, can you please explain how discount ratios, I think you want to say discount rate, how discount rates are used to evaluate long-term and short-term investment? It's not quite clear, but then let me attempt to provide some explanation to that. Please, I'm audible. Hello.
Yes, you are.
Okay. Now let's talk about this. You see, the discount rate we use must reflect the cost of raising finance today. Rule number one. That's it. Rule number one. It must reflect the cost of raising finance today. Today. It cannot be the cost at which you raise finance in the past. No. So if you have taken debt from the bank at 20% last year, we don't use it. We don't use it in the calculating work or anything. We don't use it. It must always be the cost of raising finance today. Don't forget, the market value of debt must also reflect the market value of the value of the debt today. Everything must be the value today. So when we are evaluating short-term investment, the question is, how would the discount rate be? For example, if I'm going to invest in a short-term instrument, maybe a short-term instrument we have, equity is not a short-term instrument, even though you can hold it over a short-term period, but it's not a short-term instrument. If we take something like a treasury bill, how we price the treasury bills or those short-term instruments like a 1-year government bonds and all that, we consider discount rates that reflect the term structure, short-term interest rates or something we use rather than long-term, right? But I think as a matter of relevance to the research challenge, the discount rate you're estimating is going to be more of a long-term discount rate. However, let me say something here. When you are doing making investment decision, your holding period also matters. Someone will say that, well, if I intend to hold an investment for 3 months, must I use a 10-year government bond as risk-free rate? I'll say no. In that case, it may be necessary to just use a 3 months treasury, that is 91-day treasury risk-free rate to start with. So it's a matter of also the holding period you are taking in mind. Do you intend to buy this instrument and hold it for 3 months, for 9 months, for 10 months? If you intend to hold it indefinitely, then you use a long-term treasury bill as a starting point, or your discount rate must reflect the time dynamics. But if it's just for short-term holding, you want to buy and sell, buy and 6 months time you sell, on 1 year time you sell, you may be looking for a very short term or a short rate, what we call the rates with lower, like maybe 90-day treasury bill to start with, to start formulating your discount rate. Next question here, somebody's asking, can you get a negative free cash flow? If yes, what does it imply? Yes, you can get a negative free cash flow. A negative free cash flows may imply that maybe sometimes the additional investment, you need to make some additional investment. So the net operating cash flows you are getting from the business is not sufficient to cover the additional investment you have to make into working capital and keepers. So what that means is that the negative free cash flow then is going to be treated this way. Number one, you might have to find a way of financing it. Maybe the company is going to take debt to finance it. But if it is just there in your net cash flow, which is also possible, you are going to treat it as a cash outflow. And that will mean more of an investment you are making to generate some positive cash flow in the future. Of course, we just leave it like that. It happens sometimes. You have to sometimes investigate it, but it may be necessary that the company makes some additional investment that will come at. It's not the time that when you are projecting cash flows, you should have it all positive. Some may be investment you are making, and that's the reason why they are negative, and then you expect higher cash flows in the future. Someone in computing the terminal value of the firm, should we adopt a growth model, growing perpetuity or non-growing perpetuity? That is a very, very, very good question, Silas, you have asked, because the reason is that if you're taking a typical mining firm, you have to look at the mines they have and the period over which they intend to mine that, and whether they have new mines bought. Okay, so if they have a mine that is left with 10 years to, let's say 20 years, okay, it has a lifespan of 20 years, and you have done your financial forecast for the next 10 years, it means that after the forecast period, there is only 10 years left for that mine. If you are doing the forecast or the valuation for just that mine, you can project that cash flow will be indefinite. In fact, what some people do is that they would rather project the cash flow over the entire 20 years and stop it there, because beyond that period, there's not going to be any value to the firm, because the mine is fully exploited. Or that's what they can do, is that they rather apply a multiple at the end of the 10 years to accommodate for the next 10 years how much they will be selling the mine. In other words, if they explore the mine for 10 years, after that 10 years, the mine will have just a useful life of 10 years. And then they can determine how much they will be willing to sell the mine in 10-year time. When I'm doing this modeling in practice, what I could do is that I apply mathematics. So the models is stochastic calculus. You call it geometric Brownian motion to simulate the path that the price of gold will follow. And then you're able to use that to do those calculations. But that's far beyond what you are doing. You don't need to use that at all. So whether to use non-growing perpetuity, it all depends. Let me tell you, in finance, one thing is that you defer whatsoever you do. Once you're able to make sense. So a team could be using growing perpetuity, another non-growing. It all depends on the assumption you make. But one advice I want to give you is that whatsoever you use, be able to provide basis for doing it. And that you'll be fine. Can you get a negative FCF? If yes, okay, I think I've done that. You can get. I often get that. But I told you also that use multiple methods to value the business. Don't use just a single method. And then you compare results. Now, no other question is here. I want to say this to you on discount rate, because I've not really provided you with a lecture on that. But if you like, I can give you notes. The notes on discount rate, if I have to cheat discount rate proper, it will take me like 8-10 hours. But then, let me show you. Let's take the CAPM. Everybody knows CAPM, right? Please, at this point, I want to hear from all of you. Everyone knows CAPM, right? Capital asset price.
Yes, sir.
Okay.
Yes, sir.
We start with our risk-free rate, right? I want to hear from you quickly so that I can correct you wherever
Yes,
I
sir.
think.
Risk-free rate,
How do we get a risk-free rate? What is a risk-free rate? I want to use this remaining time to complete that side. Just 3 minutes. What's the risk-free rate?
Risk-free rate is the rate on government securities.
Which government security? So if you have to get a risk-free rate for your
Money
valuation,
market.
okay, where will you go and get it? Which risk-free rate will you use if you have to get a risk-free rate to do this work? What risk-free rate will you use?
Treasury bill.
No. So let me tell you, when we are doing risk-free rate, there are two things that must be respected. I published a paper on this. If you search, I think I put it on my LinkedIn page also. I looked at estimation of risk-free rates in an emerging market. When we are estimating risk-free rates, there are two things we look out for. Number one, anything that is risk-free, the issuer of the instrument that is risk-free itself must be risk-free. In other words, the issuer of the instrument must be AAA rated. So you have to look at the country that issued the instrument, whether the country itself is AAA rated. Is government of Ghana AAA rated?
No.
No. We are not AAA rated. We have been downgraded many times. So any issues, any security we issue here is not correct. It's never risk-free rate. It's never risk-free. And I want to tell you this, guys, always take a global perspective. Don't look at local. If you look at just Ghana, you think that government of Ghana is risk-free rate. It's risk-free because that's the most credible borrower. But in finance, we don't take the local perspective for them. We take in finance value, we take global perspective. Think about a global investor who is in London looking at Ghana. Will he consider government of Ghana instrument risk-free? No. We will not do that. That's the first rule. The second rule is that there shouldn't be any reinvestment risk. If these two rules are to be respected, then a risk-free rate is the rate on instruments issued by countries with AAA ratings, like the Germany government, France, USA, Australia. Those are AAA rated. The second rule is that there shouldn't be any reinvestment risks. And reinvestment risks are risks associated with reinvesting of cash flows. In that case, treasury bills are the most appropriate to use. So we are having two things done now: treasury bill and credible institutions like US. Now, when we get to those institutional countries, like whether to use US or Euro, we have faced another problem. The problem we face is that the European Union, do I call it the Eurozone? There are several countries there. You go to France, you go to Germany, and each of these countries also have bonds and government treasuries. The treasuries may not have the same interest rate. Why is it that they are all AAA rated, but the interest rates are not the same? So it gives us some difficulty. So we need to lean to the US government, because US government too, the dollar is the most used currency, the most traded currency, and the US instruments are the most traded. So we often use the US government. That's why you see a lot of people using the risk-free rate from the US to start with. Now, I told you that treasury bill is the best. However, because we are doing valuation over a longer term, usually for investment or something, we tend to use the 10-year bond because it's the most stable rate. The 10-year rate is used to do a lot of things. It's used to infer and make several capital market expectation decisions. So even though 10-year is going to bring about some form of reinvestment risk, which we don't want, we still use it for long-term valuations. That's why we use 10-year US government yield, bond yield. And it must be the yield on the government bond as at the time of the valuation. Is that clear, guys? Now, we start it with the US, and then
Yes, sir.
if the valuation in Ghana, we bring it down to Ghana, and there are ways we do it. So I published a paper I mentioned to you. If you check my LinkedIn page, my LinkedIn account or something, you see the paper I published some time ago. You can take a read of that paper. Now, so that's how it's done in practice. That's how we get the risk-free rates in practice. That's how we get a risk-free rate. Damodaran provides a very useful approach, very useful information on beta. So you can get beta estimates from Damodaran. You go to Damodaran's site and look for beta for mining companies. They can provide you that beta. That's what you should use. Risk premium for mining companies, you can find it, or risk premium for the countries, you can find it. And you know, the good thing is that this valuation you are doing is not in Ghana City, right? So you don't need to convert the risk-free rate to Ghana City. You can maintain it in the dollars or something. If you have any other difficulty, I'll share some notes with you by tomorrow. They'll share with you. If you have any other difficulty about valuation, you can always get back to me on LinkedIn, or maybe you use my email address. Great. Any other question? I saw one question here. What will you advise we do about unit conversion? I don't understand. If you can come in again. Then Fabiola says, please, where can we find the beta? Didn't get it well. Damodaran, Professor Aswat Damodaran is a professor at New York City University. Damodaran he's an authority in corporate finance, so a lot of people listen. To go, just look for Damodaran. It's like this. Let me, to everyone. So Damodaran. You can type it in Google. You can say equity risk premium Damodaran. He will provide you. However, be careful. He may be giving you equity risk premium he's having it for several markets. Your research challenge you are doing, you must know the market you are dealing with. Whether the Asante Gold, of course, they have mines in Ghana here, but then you must look at if you are doing a valuation in CD, which I know you are not doing. If you are doing a valuation in CD, then a lot of things like you need to convert the risk-free rate to CD risk-free rate. But then if it is in dollars, entirely you can keep the risk-free rate the way you have found it in the US market and all that. And a beta, you can find the country. When you are dealing with beta, look at where Asante Gold gets most of their revenues from, and use the beta of those countries and find some kind of weighted average, the equity beta of those countries, and find some weighted average. If almost all their revenues are gotten from Ghana, then it should be entirely the equity beta for emerging market. We don't have it for Ghana specifically like that, but you could have it for emerging market. You check. I don't know whether he has now updated for specifically Ghana, but you can actually get it for emerging market. What you could usually find for Ghana is a country risk premium. Yeah, great. Thank you very much. And I'll provide some guidance and I'll share with you as well on the cost of capital and all that. I'll share that with you as well, and I'll provide that and Ifri will share with you. Right. Thank you, guys. Thank you very much. I hope you enjoyed my session, even though I have a short period of time to present a whole lot of things I want to talk about. So several things I couldn't talk about actually, but I hope you enjoyed it. Let me hear from you. Final words before I leave. At least show me some love. Let me hear from you.
Yeah, thank you so much. This is Silas.
Okay, Silas.
For one or two reasons, because of the rain, I had to join in very late, but I might say I enjoyed your presentation all the way from the way we value debt down to where we ended. I've learned a lot there. We hope you take those insights and changes in our operations. Thank you.
Welcome. Thank you very much. And I will share some information on debt valuation with you, how we do that, how we treat the debt. I'll share that with you, how we even get a market value of bank loan. Let me get one more person and then I move away from here. Free is waiting for me to leave. So let me get one more person.
Yeah, please. I would like to say I appreciate you teaching us new things, especially the evaluation. I really learned new things in this course, although the network of university from the session one, but when we got to the third part of the session, it was enjoyable. Thank you very much.
You're welcome. Thank you very much. Okay, thank you very much. All right, guys, thank you very much. Ifri, thank you very much for the opportunity. I really appreciate. And then my email, let me just is here. I think they'll share the notes or something with you. You can have my email address here in case you want to communicate with me, or my number is there. So you guys can WhatsApp me if you need my assistance or explanation or anything. I'm always available. Thank you.
Thank you too.
All right, Ifri, take over.
Yes. Thank you so much, Julius. Thank you for the session. We are at like 7 minutes behind time, so I would hand over to Michael, who's going to take over the report writing and financial statement analysis. Michael, please. We are ready for you now.
Yeah, thank you very much, FEA. I just have to share my screen, right?
Please, you can put in a request. I'll just accept it and then we can move on.
Okay. Yeah, I just did.
Yes, we can see it.
Okay, all right. Thank you very much. Yeah, so it's a pleasure to be on the call with all the participants. Just a brief background about myself. Yeah, my name is Michael Akpao. I was also in your shoes. I graduated from Manchester University in 2018. And then I had the opportunity to work at Bank of America Merrill Lynch in London. It was an equity research, covering European business services, stocks. And then I went back to, I moved back to Ghana to join Blackstar Group. Most of you know that company. So I was there. I continued in equity research, and I was also doing, investment banking at the same time. And then, I was there for like 2 years, and then I joined a private equity company investing in space technologies. I did that for like 2 years, and I thought of doing my MBA. So I'm currently in my second year at MIT Sloan, where over the summer I had the opportunity to also work in private equity. So it's always a pleasure to be a member of to be volunteering for the annual research challenge. Yeah, so that is just a brief background about myself. Today we're going to talk about equity research. To give the slide, it's supposed to be financial statement analysis. Yeah, equity research and financial statement analysis. And I want to make this session interactive as possible. So please don't keep your mic on mute throughout. Okay, so the key discussion points, it's broken into two. Like I said, equity research, report writing, and then financial statement analysis. Give me again. Yep. So we'll just go straight into any of you. What do you think is an equity research report? Is any of you willing to break the ice? I'm going to cold call. Hello. Nobody wants to give this a shot. Okay, all right. Are we good?
Yes, we are. They are quiet.
Okay, so basically an equity research report, right, is the first. What you guys are going to doing with Asante Gold is basically called an initial coverage report. And an initial coverage report is basically the first formal assessment you make on a company, right? And the essence of this is basically to do a deep dive on the company, from the company's history, operational performance, what the company's growth prospect and outlook looks like, and any catalyst that you think is going to help propel the company to achieve the target that you've identified in the research report. So in that research report, you talk about the company's history. We'll delve more into that in the subsequent slides. But high level, you talk about the company's history, financial performance, the product lines of the company, the management team, and then typically what you do is you come up with a price target, right? So I'm sure in your previous presentation you spoke about mining valuation basics. So you do your valuation on the company and then you come up with a target price. And basically that is what you think the company's intrinsic value is worth. And what you then do now is to compare that to the market price of the company, and then determine if the company is undervalued. If it's undervalued by the market, in that sense, if it's significantly undervalued by the market, then you think it's probably a buy recommendation, so investors should buy it. If it's overvalued, you think investors should sell it. So these are just high level what an equity research report looks, and it's basically to inform investors, to give investors the opportunity to make informed investment decision. So typically on some of the pages, especially on the first page, you see the title of the research report, and that is basically informed by whatever you've uncovered throughout your analysis. You see some charts on the company's stock performance. So chart versus volume. You have, a brief summary of some of your key findings, like your target price, some returns. What do you think the company's return looks like over the next few years, and basically like a brief financial projections of the company over the next few years as well. So that is basically, an overview of what an equity research report is. So there's typically, before I go to the next slide, there's typically what you guys are going to do for Asante Gold is what we call an initial coverage report, and that is typically in-depth. So you have that typically like 30 to 40 pages, because that is the first time an analyst decides to cover a company. So typically in practice, over time, after the initial research report is published, typically on Bloomberg, on Refinitiv, on any of these, public research platforms. Subsequently, every quarter you issue what you publish what is called an earnings update. And the earnings update is basically to determine if the company is on track to meet whatever thing that you said, or to achieve whatever milestone you had said, you had reported or published in your research report. So if you estimated or projected that the company's margins or profit is going to be X, maybe $20 million whatsoever, at the end of the quarter, you reassess and see if the company is in line to meet that estimate, and how that estimate compares to the company's own projections and analyst estimates. And based on that, you determine, okay, because you've issued a target price, and typically your target price is, let's say, 12-month target price. So at the beginning of the year, at the end of the first quarter, you assess and see if the company is in line. If the company is in line, then you maintain that. If you're more bullish about the company, then you probably have to be a bit aggressive with your estimates. Otherwise, you have to reassess and be maybe conservative. And all of this is going to influence your target price over time. So that is basically, so the earnings reports or the earnings update is typically like a few pages, 2 to 3 pages, which is basically like a continuous update about the company's performance after your first initial coverage report has been published. So now let's go back into what the components of an equity research report is. So typically you want to know what the recommendation of the research report is. So as an investor, if you are the equity research analyst and you are publishing this, the recommendation is very important, because the recommendation is basically like a summary of your investment, right? Of your investment idea. So if your recommendation is, hey, typically you have 3 recommendations, right? I mean, there are other ones. People make it very interesting, but then basically 3 recommendations in simple terms. So we have your buy recommendation, sell recommendation, or hold. And you issue a buy recommendation, and like I said in the previous slide, is basically if you think that the company is significantly undervalued by the market, and you think that it's unjustified given the company's financial performance, company's competitive positioning in the industry, the company's demand outlook. So you believe the company is undervalued by the market, and which in your view and in your analysis, you believe that it's unjustified, right? So you have a buy recommendation. If the target price, based on your valuation and analysis, you have, let's say a target price is $20, but then the market price is $10, then the company is what? Undervalued, because the market price is lower than the intrinsic value of the company. A sell recommendation is the opposite, which is you've done your valuation, and the valuation based on your DCF, your discounted cash flow analysis, which I believe you've gone through extensively in your previous presentation. That basically means that your DCF value is saying that the market has overvalued the company. You did a DCF analysis, and your DCF analysis is saying that the company is worth, you believe the company is worth $10, but it's trading on the market at $20. Then you think that, probably the market is just overexcited about the company for no reason, for no fundamental reason. So therefore you think it's a sell, and that over time there's going to be a correction in the market. A hold recommendation is basically you are potentially waiting for more information, like you really want to understand what is going on in terms of the company's growth outlook. So you've done your recommendation and you believe that the company is fairly valued. So for instance, you did a DCF and the company is worth $20 and the market is probably valuing the company at $19.5. So at that level, you see, okay, well, there is not enough upside and there is not enough downside for investors to either trade, maybe sell or buy more. So at that point, your recommendation is basically telling investors, hey, I think if you're already in the stock, if you're already a shareholder, just take your time, don't buy more, just hold it. If you get more information about the company, as you cover the company over time, you might, change your position or your view on the company's outlook. So those are the top 3 recommendations, which you have to sell, buy, sell, and hold. And in that initial coverage report, company background is very, very essential. So the company background, basically the company's operations, right? So the background, you want to talk about the company's product lines. You want to talk about the company's leadership team. Do you think that the leadership team is competent to run the company? Leadership is very important when investors look at a company. They look at the leadership team to determine if the leaders are the right people to lead a company to the next stage of growth. So the background is very important to basically talk about how the company started, the company's financial outlook, any other growth plans that the company has set. You can potentially sort of include that in the background. And then your industry analysis, which is also very key. How does the company stack with the industry? So basically, how does the company compare with its own peers? And also its own history. Is the company gaining market share? Is the company losing market share? And if so, why? Right? Is the company also introducing, new product lines that potentially will give the company enough competitive edge over its peers? You can talk about the Porter's 5 forces. Well, in most of the research reports that I've seen in practice, they potentially don't talk about that, but this is something that you can also sort of, through. So the industry analysis is basically trying to determine where the company stands. Where does a company stand versus its own peers, right? Is a company a market leader? Is a company trying to catch up? What is the company's market share? How does that evolve over time? All of these are very, essential as you talk about the company's industry outlook. And then you also want to talk about the investment thesis, which is very, very important. That is basically the foundation of your research report. The investment thesis is basically typically 3 forward-looking statements about the company. And that ties everything together from your recommendation all the way to your valuation, right? All the way to your investment, to your valuation. That is what the investment is. So it's basically the foundation, everything you're trying to uncover from your analysis. So a quick example is you've read the company's annual reports, you've read their presentations, you've done your research, you've maybe potentially joined their earnings call, you read their investment presentations, and then you start realizing that, as you read, you look at their financials, you start seeing some trends, right? Maybe it has to do with a new product line that they're about to sort of introduce. And then you believe that this new product line would likely help the company capture X% market share or grow its market share even more than the peer. So this could be one thesis. This is one investment thesis that you have identified. So an investment thesis is basically like an investment idea, which is typically forward-looking statement that you believe are essential to help the company, meet its growth target. So if the first one, we talk about potentially the company's introducing a new product line, and you probably also, based on your analysis, you came up with an interesting finding and realized that, okay, well, the company has a very, very strong balance sheet, which may mean that the company is well positioned to, in a very in a high interest rate environment, the company is still well positioned to take on more debt because it has strong cash generation potential than its peers, right? So you say, okay, well, we think that the company is about to introduce a new product line that will help it capture this percent market share. And this is how you think it's going to impact the company going forward. The second investment thesis is you think that the company has a strong balance sheet because you've done your investment analysis and you believe that maybe the company has a low leverage balance sheet. In other words, the company has low debt load versus the industry. So that gives it enough balance sheet headroom to take on more debt in order to, use that sort of debt to help drive its growth initiative, right? So this is a second investment thesis. The other investment thesis could be like an industry, how do you call it? An industry catalyst that you think is going to help the company again meet its growth target based on all the analysis that you've conducted. So based on experience, it's typically limited to 3. Your investment thesis limited to 3, and this is what informs your investment idea. So the question is, okay, how do you come up with an investment thesis? Or how do you come up? Yeah, how do you basically come up with an investment thesis? And it has to do with a lot of reading and a lot of research. So you have to read the company's financials. You have to look at what is going on, is happening to competitors, see if you're identifying any trends in the industry. You have to read the company's presentations because that is typically what we call, those annual presentations. I think here they call it Capital Market Day, like in advanced countries like US. So when you read those sort of reports, you can tell what management, you start discovering what management is saying, what management's growth strategy is looking like, right? So, and then you start forming a story, forming an idea, and then you look at the financials as well, see if whatever management is saying, how does that compare to their financial performance over time, right? How has the company's growth outlook, changed over time, revenue growth, EBITDA margins, net profit margins, cash flow generation potential, especially your free cash flow, the company's free cash flow. So all of these is a lot of reading, a lot of research. And then the more you read, the more you start uncovering themes from the company, like interesting themes that has to do with, growth, that has to do with investment initiative, that has to do with capital expenditures. For instance, maybe the company is about to, acquire a new machine that is going to help. So for instance, in this case, the Asante Gold is about to acquire a new equipment that is, that has the technological capability to help them mine efficiently without waste, right? So that can be like another investment thesis that you identify. And you don't identify these things if you don't read the financials of the company, if you don't read the reports of the company, because those are the places where you discover what the company is talking about, what management is saying. So this is how you come up with an investment thesis. Like I said, just limited to 3, and that is basically the foundation of your research. So you start with, we initiate coverage of, Asante Gold based on our investment thesis. The first one is, we believe the company is well positioned to grow its market share by X% because of this specific initiative. And then number 2, we believe that the company has a strong balance sheet headroom, given that it has ability to, to take on X amount of debt, right? And the company's strong cash flow generation potential is going to help the company pay its debt burden over time without any challenges. And then the third one could even be management. Maybe they are hiring a new CEO, and that new CEO has a strong track record of performance, right? Maybe the companies you've done your research about that individual, and you believe that wherever that CEO has been to, he's been able to grow companies double the size of the company over time. This can be like an investment thesis, and these things you you don't, discover these things if you don't do your research, read about the financials and presentations. And you have your catalyst. Your catalyst is basically what do you think is going to help drive your investment idea and all the analysis that you have done. If you're saying you expect the company is trading at the share price of the company is now $20, but based on your analysis, you believe the share price is going to be, let's say, $30 or $50 by the end of the year. What is going to happen to help propel the company share price to that level? So this is what we call the catalyst. What is going to be the driving force to move the share price from mid-current level to the level in which you are anticipating or project? And your catalyst is also going to, it can be, especially given how developed, the US market is. You saw, if you follow the US election, you could tell that when Donald Trump won, there was a sudden rebound in the market, like a huge rally in equities, in the equity market. And the reason is because investors believe that Donald Trump is going to come in and cut taxes. And then, and he's also promised deregulation policies. And taxes, you cut taxes, what that means is that more money in the hands of companies. Companies generate more profit. And therefore, when companies generate more profit, investors get more money, right? So that is what the market believes, that Donald Trump's policies will help generate more profits for the company. So the market is now responding to that. That is a catalyst, right? It would have been probably the opposite if Kamala Harris had won. So if the catalyst can even be like a news event. You've read in the news that a company is probably entering into a joint venture agreement with another competitor, and they're coming up with, trying to, join forces together to drive the operations because they want to sort of achieve a specific target. That can be a catalyst to help drive the company share price. Another catalyst could be earnings update. An earnings update is typically when a company reports its earnings and beats estimates. Maybe the market is expecting the company to generate 10 billion in profit, but then the quarter ended and the company actually generated, let's say, 15 billion. The market is definitely going to respond positively to that, and that is going to help propel the company to achieve its target. So there are various forms of catalysts that you can drive the company share price, and all of these, again, you wouldn't find these if you don't take a close look, a critical look at the company's financials, follow the company. Every report that is critical to the company's operations is essential. That is how you come up with your catalyst. It can even be like a regulatory update, a regulatory change. There's probably like a regulation that is going to help mining companies. Yeah, so basically this is not extensive. So like I said, this is, an overview of a general overview of what to expect. But again, a lot of the work depends on you. You need to go out there and read a lot about what is going on in the company. And obviously the last thing you want to talk about is valuation. You've done your valuation presentation, and I'm sure that the presenter covered a lot of the basics. But basically the valuation is what you think the company is worth from an intrinsic perspective, right? So you have to do your DCF, right? You probably have to do your comparable company analysis. And based on what all of your analysis, your fundamental analysis, you come up with a target price. And that is also very peculiar to what equity research is about. You always come up with a target price and say, hey, I believe, or we believe that this company is worth X amount of dollars because of XYZ, right? So the valuation for a mining company, you probably want to do your DCF analysis. There is also industry-specific valuation metric for a mining company, but DCF is generally, widely accepted and typically used to value companies that have a history of generating some amount of cash flows. Yeah. So at this point, I've been talking too much. If you have a question, just let me know, because my intention is to make this interactive as possible, so I'm not the only one talking. The first question I asked, I didn't get any answer, but hopefully this has given you some background of what we want to cover. So if you have any question, please let me know. before I move on to the next slide. Are you guys hungry?
No, please, you're listening.
Okay. Any questions before I move on? Valuation, I guess, you've covered that, so it's just like a high level talk, but happy to take any questions on that. Oh, okay, so we had the last one. I thought that was, yeah. So investment risk. So the investment risk is also very important. Every investment idea involves risk. So your risk, what is the risk of the investment? Do you think that what is likely going to happen to make your analysis void? Right? Well, whatever that you've said, if you have a strong buy recommendation on a company, what do you think are the risks of that recommendation? And typically, your risk should cover like macroeconomic risk. It can be company specific. So company specific risk can be risk that is specific to the company, associated with the company, and that has nothing to do with the market. So if there's company specific risks, it could be for instance, the CEO who was how do you call it? It's the CEO who the market believe is the right person to lead the company is about to resign. Right. So that is a risk, because if a new person comes in, it's the new person is coming to start from scratch, and the market would at that point probably might be skeptical as to whether the new CEO will be able to drive the company's operations. So that can be a risk, which is company specific. CEO is about to resign. It can also be anything that has to do with the company's own execution initiative. So maybe the company has issues with its mining equipment, right? And you think that this could potentially impact the risk of the company. The ability of the company to achieve its growth initiatives. It could also be financial risk. Maybe there's too much debt load on the company, right? Now, when you identify this risk, so we said company-specific risk, which is risk that is specific to the company and has nothing to do with the market. There's also like market-specific risk, which you want to look at macroeconomic risk, which is affecting that sort of risk. Or macroeconomic risk are affecting all players in the industry. So it can be regulatory changes, it can be the interest rate environment. Yeah, and it can be anything that is happening in the market that can affect them. It can be, for instance, prices of mining equipment, right? Maybe prices of mining equipment, the machines, the equipment they use to mine have been skyrocketing to the point that, it's difficult for these companies to acquire, to purchase them. And obviously, when these prices are expensive, they have to pass it on to consumers. And the key question is, can consumers absorb this increase in price, right? If that happens, potentially there's going to be a squeeze in margins. Margins are going to contract because the company is not able to pass on the increase in prices to the market. When you identify this investment risk, what you need to come up with is risk mitigants. And especially if you have a buy recommendation on a company, you don't want to send this to an investor after all your bullish outlook on the company. You believe the company is well positioned, the company is significantly undervalued, and then you come up with investment risk that essentially nullify everything that you said in your analysis, right? So it's important to come up with risk mitigants. If you identify the risk, what do you think the company can do or is already doing to mitigate this risk from actually materializing, right? So you don't leave the risk in isolation. Otherwise, like I said, it's just going to nullify all the bullish things you've identified about the company. In terms of positioning these various aspects of the research, I don't think there is a specific way. You can decide. People leave it at the last page because they don't want the risk to sort of dilute all the positive things. People also want to leave the risk, at the initial stages, at the initial pages of the research, so that once you see the negative, you now just go into the positives, right? And then by the time you finish reading the positives, which is the bullish things you've identified about the company, you probably would have forgotten the investment risk. So positioning of this is it's solely up to you. But then I guess I'm sure CFA Society Ghana will share like a template with you guys that you can run with. So I've spent so much time on this slide. Let me just go quickly. What are some key drivers of an equity research report? I think I probably touched on most of them. Anybody wants to give it a try? Since none of you are trying to, everyone is mute. Let me just go quick then. So recent result announcements, and the essence of this is the key question here is how does a recent public launch, earnings release, potentially there's a merger, there's an acquisition, the company is trying to target and buy another company that you believe is going to help drive the company's revenue growth, or loss of a key customer, etc., change your view on the company, right? So these are some of the things that you look out for when there's a recent results and announcement. All of these is going to help drive your equity research report, your analysis, and obviously your recommendation. Macroeconomic environment. How does inflation, interest rate, impact the company? Do you think the company is insulated, as well positioned to withstand any increase in the interest rate environment? Inflation, you want to look at how much of all of these is impacting the company. Obviously, regulatory environment is also very important. I think there are a lot of regulations that is governing the mining industry. So how does regulatory changes impact the company? Is the regulatory body, coming up with more stringent or strict regulations that is limiting the ability of the company or of Asante Gold to continue to take risk? Look at what is happening recently in Ghana, where there's been, public outcry about galamsey, right? So how do you think this is going to impact mining operations, right? Is that potentially going to limit the ability to get licenses, right? To go and explore new mining areas, right? Because everyone is concerned about illegal mining. How does that potentially affect legal mining, right? Maybe there's going to be a huge backlog. There's going to be a huge a lot of bureaucracy when it comes to the ability of the legal miners to get, the regulatory clearance to go and, more or less, explore any mining sites. So it's very important. Target price versus valuation ranges. So the standard practice is to placing an emphasis, especially in equity research report, placing emphasis on target price rather than valuation ranges. So in investment banking, if you're advising a company, and maybe the company wants to acquire another company, when you're advising that company, you give the company range of potential values that you think they should acquire the company at, right? So you're going to say, hey, we think, based on our analysis, we think the company is worth anywhere between $20 a share to $50 a share. So if you're able to pay in between, this range, then obviously we think it's a fair value, like it's a fair price. But equity research is different. And people always have different opinion about this, that it's always hard to place a single price point on a company. Like, think about it. You say Apple is worth $200 per share. Like, who knows? Nobody knows, right? But then there is a price that everyone believes, okay, if I pay more than 300 or 400, I think then it's not making sense. It's probably too expensive. And there is a price that people expect, that people think that makes it a fair valuation. So the target price is what an equity research places emphasis on and say, hey, we initiate coverage of Asante Gold based on a target price of XYZ compared to its, closing price of, let's say, also like, whatever the closing price is. If you compare the target price to the closing price, if it's a buy recommendation, then obviously you believe there is an upside potential. An upside potential is basically the amount of undervaluation that the company is undervalued by. So if the company is if the intrinsic value based on your DCF is $50 and it's 25, the market is trading at $25, then there's significant upside, right? And if it's opposite, then there's a downside. So whatever you say, if you initiate the coverage of a company, you're saying that at the target price of this, and then you now introduce your investment thesis, right? So again, I believe there is going to be a template. I'm seeing some questions here. I don't know if it's, give me a second. Oh, okay. I thought that was to me. Yeah, like a few years said, this is the last session. I know you guys are tired. Please, let's make this interactive because I've been talking for the most part. I know you guys are tired. Anyway, so the standard practice, like I said, is to come up with a target price. And that is based on all the valuation that you've done. It can be the DCF, your comparable company analysis. And then based on that, you can come up with an average or weighted average of all of these valuation metrics and say, hey, okay, based on what we've done, everything we've done, we believe the company is worth this amount of money. So that will be it. Before I move on to the next session, which is financial statement analysis, let me know if you have any questions. Come on, guys. You can't tell me you don't have any question on equity research. Sorry?
Hello, sir.
Yes, hello.
Yeah, please, Silas.
Yeah, can you when you ask the question, can you start with your name, and school, your affiliation? Yes, that would be very helpful for the rest of the the participants on the call.
Okay. So I'm Silas Lado from UG.
Okay.
And my question will be from the investment risk. For example, based on your analysis, if you're able to give a recommendation, maybe a positive one, which recommends a buy decision or a buy option. But then there is this risk that you've identified, which, for example, maybe a political risk, which, so if you identify the risk, you should be able to propose mitigations. So maybe you identify a particular risk, especially a political risk, that you don't have information enough to be able to propose the mitigation to that specific risk. The fact that you've not been able to, or you don't have enough information at the time of reporting to propose a mitigation, does it mean that that still nullifies the positive orientations that you came up with the firm?
Yeah, that's a good question. So for instance, every company is exposed to, political risk or has exposure to political risk. And certainly I think, mining industry is one of them. Because, a new government coming in probably might make things difficult for the mining companies to come up with new regulation, whether it's more regulation or deregulation, nobody knows. So at that point, if you don't have enough information about what the company can do to mitigate it, what you could do is look at how the company has fared anytime there's been a new regime, right? So you come up with your investment risk, you say, okay, well, we think that, or we believe, you believe, and take note of the language in equity research. It's always, we believe, we initiate coverage, we believe the company is worth this, XYZ, rather than using personal pronouns. So we believe that in political risk is one of the things that, might affect the company's ability to meet its growth initiative, right? But then if you don't have enough information, you go back to history and look at what has happened anytime there's been a new government, right? And you're going to be like, okay, well, however, anytime there's been a new government, the company's operations haven't been significantly impacted. But in contrast, anytime there's actually a new government, the company has grown right from, let's say you look back maybe last 10 years ago, the company has been able to grow its revenue, grow its profit, increase its cash flows, regardless of whoever is in power. So that gives you a strong conviction that even though there's a political risk here, you believe the company is well insulated because the company has demonstrated over time that regardless of the political power, the political party in power, the company is still able to drive or achieve its growth target, is still able to, to be a clear, a leader in the industry. Yeah, so this is how, especially when you don't have enough information, you want to look at how the company has, how do you call it, has been affected and the similar scenarios in the past and how they've been able to respond to that. Does that answer your question?
Yes, sir. But I would like to make a follow-up. I don't know if the time will permit. For example, there are a group of people that are currently working on looking at the emergence of coup d'etats around Africa, trying to identify what are the remnants of coup d'etats in Africa. So for example, they are able to come up with certain findings that show that if these indicators prevail in a particular nation for, let's say, this duration or this amount of time, there is a likelihood of a coup d'etat emerging. Now, these are sensitive findings. Perhaps if the political risk is in a way linked to something like that, maybe in the next 15 years from now, the next 10 years from now, if those things are happen to be showing, I want to know how diplomatic we have to go about certain things like that are very sensitive, even though also relevant for considerations.
Well, let me share my view on that. So are you saying that risk that you've identified that will happen in the next 3 years?
Yes, but are very sensitive.
Very sensitive. I think for the purpose of this, yeah, in equity research report, I think you don't want to be too sensitive on issues that you don't have control over, right? Like even if you're covering a company, nobody ever predicted, how do you call it, COVID. So you had a company, you could cover a company in the within a few months, and then the next thing you know, there is, like there's a war. I mean, this is something. It's also very sensitive things, right? Given what is even going on in Israel, like the war in the Middle East and all of that, very sensitive stuff. But these are things that is out of your control, right? So I think just for the purpose of this, just limit your how do you call it, your investment risk to things that are very immediate, right? It can be if it's as far back as 5, it's going to happen in 3-4 years. It's risk, right? But technically, practically, initial coverage report, like I said, is when you issue an initial coverage report, you have a 12-month investment horizon, right? So after that 12 months, you come back and reassess again. Did anything change? Okay, like in practice. So I agree with all of what you said, but you don't want to be too sensitive in an equity research report because in practice, you are going to be publishing this in the name of your company, right? On Bloomberg, on research platforms where you don't want to be too sensitive, to the point where you might put your company at risk. Okay, so you have to be professional as much as possible. Don't let your emotions, again, yeah, maybe let me stress this. Don't let your emotions cloud your judgment, right? Just because of how you're feeling about something, don't let it cloud your judgment. So in practice, even if if you are analyzing a company and even if you are an investor in that company, you need to have full disclosure to say that, hey, I've invested in this company, but whatever analysis I'm doing, it's not going to affect my objectivity about this company. And in most cases, they might say, hey, if your company might come up with a compliance, procedure to say, if you're an investor in this company, you're not allowed to cover this company. So there are a lot of, checks and balances in place to ensure that people don't get too sensitive with things. And then, the risk of the company, I mean, so that the company is also being able to manage the risk and all of that. Okay. But if you have any discussions, I mean, we can take this offline. You can reach out to me, reach out to the CFA Society, Nana, FEAMs, and they can guide you on what to do, what to do when you identify some of these things. Okay.
Very much, sir.
Any other question? If you please let me know when we are running behind time because I think I've spent a lot of time on this. So Maybe we can reserve some of the questions. Let me just run quickly to the next thing we want to talk about. I'm going to run like the speed of light because I know you've covered most of that. Financial statement analysis. So like, why do financials matter? Anybody want to give this a shot? As an investor, when you look at a company's financials, why does that matter to you? Come on, guys.
Yes, good afternoon.
Yes, your name and affiliation.
My name is Israel. I'm from UPS.
Okay, yes. Go ahead, Israel. What do you think? Why do financials matter?
For investors, it helps us to know sometimes we can target the profit and see whether they are improving on the,
Can you
they are
speak loudly a little
improving.
bit? I can hardly hear you.
Hello, can you hear me?
Yep.
Hello, yeah. I'm saying for investors, we can look at the profit and see, comparing to the previous year to see whether the company is improving.
Right. Yeah, that's good. So compare that to you look at the company performance, over time to see the company is improving. Yeah, that's good. Anybody else?
Yeah, hello.
Okay.
Yeah, go ahead.
My name is
Selassie. Okay, go ahead. Who's that?
my name is
Okay.
Komla Tunumba, Ashesi University.
Okay.
Yeah, it can help tell the expected dividend payout ratio for the forthcoming period.
Okay, that's one thing. So all you care about is this at this point as an investor is how much money you are getting in dividends. So you look at the financials to see how much dividends you're likely going to get. I think I saw somebody else.
Okay, so I think
Selassie, your name and affiliation.
Selassie, yes, Selassie Mensa, Ashesi University. And so I think that financials matter. Okay, this is not like directly for the investor, but then to be able to know like the proportion of, let's say for the various items that's going to, let's say, revenue, which are the cost drivers, which are the revenue drivers, like, and things like that, to be able to know the strengths of the company and if there are some adjustments, where to take them from.
Okay, so I guess what Selassie was trying to talk about or to explain is financials matter because you look at the financials and it helps you understand the company's, fundamental outlook and performance. So you do your analysis, you do your ratio analysis and whatnot, and then you uncover how much cost the company is spending in this, how much growth initiative, how much is the company investing in its, how much capex investment is going on, how much cost is the company taking on, right? How is that improving or impacting the company's outlook? So certainly that is one of the reasons why financials do matter. Yeah, but everything that you've said is true. So so if you're invested in a company, what's the first thing you would want to know? And everything that you've said is true. As an investor, you want to look at these financials to understand, okay, how much money am I going to get in dividends, right? You're also thinking of investing in this company, but you look at the financials and your decision is, okay, well, maybe this company is undervalued by the market. Maybe it's time for me to buy some of the shares. As a customer, you also want to look at this. For instance, if it's a creditor, you want to look at the financials of the company to see if the company is well positioned to pay you anytime they come and ask you for help, right? Even as an employee, these financials are going to help you. If you're working with a company and the company has been performing bad over time, then obviously there is a risk. The company could likely go out of business and you could also, lose your job. Key example, if you're following the market, Spirit Airlines, which is one of the airlines in the US, they recently have filed for bankruptcy because they are currently running at a loss. The airline industry is super competitive. So even if you Google the share price right now, the share price is almost close to zero, right? It's almost like $1 because the company is not generating any profit. Where now investors are just selling the stock, and potentially, if you're working in that company, as an employee, I don't think, you would definitely feel like, okay, you need to be looking for a new job. So all of this matter. And there are several reasons, right? Even the government, you also want to look at the company to see the financials, to see if the company is saying what they're doing, like especially when it comes to its responsibility to the society in which it operates. Obviously, the government is also interested in the financials for tax purposes, right? So all of these are important reasons why. So if anything you want to cover, all the questions that you have in your mind, the financial statement, hold the answers to these questions, right? So you look at the financial statement and then you can straight away, you don't look at just one financial statement in isolation. You look at these and it's going to help you answer every question you have. Whether it's an investment you want to do, you want to acquire the company, you're trying to determine whether to buy or sell the stock. All of this is important. And like I said, as a customer, as a creditor, even as a regulatory agency, even as an accountant, you want to see if the company is how do you call it? It's operating in a fair way or hasn't breached any of the accounting regulations or whatsoever. So the three big financial statements, you guys are very smart and I know you know them. So we're going to run again like a speed of light. The three big financial statements is what we have, your income statement, which is basically how much money the company made and spent. You have your balance sheet, which is what the company owes and owes, what the company owns and what owes. And then you have your cash flow statement, where the money is coming from and going to. All of these statements are very, very important and they are actually interlinked, right? So you can look at a company's income statement, right? And the company potentially might be generating, you look at their revenue line, their top line, revenue line, and they are generating revenue every now and then, but the revenue recognition is very aggressive. Meaning, there's a lot of account receivable, customers are paying and are not paying, are buying the product and are not paying upfront, right? So the company potentially gives them, how do you call it? Maybe payment terms where the customers are expected to pay over 6 or 12 months. But then because based on accounting for the accrual accounting concept, the company is still going to recognize that as revenue, right? But then the money is probably going to come in next year. So you look at the income statement, revenue is going to look good, the numbers are going to look good. But then you go into the cash flow statement, you realize that the picture is different. Because the cash flow statement is going to say, oh, okay, you said you were making all of this revenue, but actually you are not getting the cash. The cash is not coming back in the next, it's only coming back after a year or after 6 months, right? And it's so important to not look at one financial statement in isolation. You have to look at all of these three financial statements. And that helps you paint a clearer picture about the company to understand how much money the company saying is making, what is the resources that a company has, and where is the money coming from, and where is it going to? How long is it taking the company to get this money? And the cash flow statement, very, very critical. Investors look at the cash flow statement to determine how much cash. It's all about cash, and valuation is all about cash, which is why the cash flow statement is one of the most important financial statements of the company. Valuation is all about cash flow, how much cash the company is generating, right? Regardless of its accounting policies, right? So for those of you who are aware that we always say, there's this always saying that, the financials, how the financial statement link together. I'm sure if you start applying to, some of these equity research or investment banking roles, in Ghana or internationally, you're going to be asking you, how does the three financial statements, how are these three financial statements linked together? So you realize that in the income statement, you have it all the way to the bottom line, which is your net income. And your net income directly flows into the top line of the cash flow statement, because in the cash flow statement, you have net income, and then you add back any non-cash charges, right? And then you make you do any adjustments in working capital. I'm not going to go deep into this working capital to get your operating cash flows. Your cash flow from invested activities actually captures any capital expenditures that you have as a business, right? If you buy a new equipment, it's going to go into cash flow from investing, financing, anything that you have that has to do with raising new money. So for instance, there's equity share repurchase programs, raising debt. All of that is going to appear in the cash flow from financing. And at the end of the day, the three segments of the cash flow, which is your cash flow from operations, which tracks the company's core operations, cash flow from investing tracks investment, cash flow from financing tracks anything that has to do with raising new money. The summation of these three segments actually gives you an idea of the company's cash position. And the same thing happens in a balance sheet. The net income also flows into retained earnings in the balance sheet, right? And all the changes if you look at this side, all the changes in account receivable and inventory, those are the changes you see in the cash flow statement and the cash flow from operations. So this is just a brief, just a high level picture of what a cash flow statement, what a three segment is about. You look at the income statement, the company might be making a lot of money. And you go to the cash flow statement, the picture might be different, right? So you don't look at these in isolation. All of these statements are very important. So I just decided to do because you guys are going to be analyzing Asante, let's take a look at Asante income statement, for instance. I just took a screenshot of that and pasted it here. For these 2 years, right? From 2023 to 2024, what are some of the trends? What story can you tell from Asante income statement? And please, I know this is probably very, the text is very small, but what do you guys, anybody to tell us something? What is standing out here? If you look at this statement from 2023 to 2024, what is something that, immediately catches your eye if you've not gone ahead to do any fundamental analysis? You just take a cursory look at this. What stands out for you as an investor or as an analyst? Any question? Anybody take us away?
The operating loss has increased.
Exactly. So operating loss has increased by a significant amount from 108K. I think it's 108,000. Sorry?
72,000 plus or 72,000.
Yeah, exactly. That's a lot of money, right? Yeah, so that's what stands out. If you look at this from scratch, okay, well, wow, what happened? How has operating loss increased from 108 million to 181 million dollars? Any other thing that stands out?
The cost of sale is saving. It's like times 2.
Wow, exactly. The cost of sale has doubled. It's doubled. So if you are analyzing this company, you're like, okay, well, what has happened in 2024? Why is the company spending so much on cost of sales? Why, what is happening? Is it an efficiency problem? Is it an efficiency problem? Is it because of increasing in prices of maybe potentially it could be those that actually engage in the mining? Are they paying these people more? Is it difficult? Like, is the prices of these mining equipment, the machines, whatsoever, has it doubled? So you look at these things and you'll be like, okay, well, what is happening? The numbers is telling you something, but then you have to dig deep. You have to go into the financials and understand what happened, what really happened in this particular year. Why has this, almost becoming like an outlier? So you see that even though revenue has also almost doubled, gross loss has also almost doubled because the company is growing its revenue, but at the same time, it's growing its cost of sales by a huge amount, right? So that is draining the company's ability to generate profit. Yeah, thanks for catching that. So maybe quick way, exactly whatever you said. If you look at the finance charges of the company too, from 2023 is jumped from 9 million to 30 million, right? So the company is actually incurring a lot more interest expense. So maybe the company has gone to take on more debt. And as an analyst, you need to understand what is happening. How does this impact the company, right? How does this new debt that the company has gone to take on impact the company's financial outlook? Because the more debt you have, there's a financial risk. you need to determine if the company has enough cash flow to service its debts. Look at the net loss as well. The company is still generating, it's not making money, it's actually generating loss. And we are going to come, when you move to the cash flow statement, you will see what is happening. That there's, whether, the cash flow from operations that the company is claiming to be receiving or to be generating is actually from its core operations. So, and that is the key thing we look out for in valuation. Valuation, we want to value the company based on its core operations. So whatever the money the company is making, if it is not coming from the company's core operations, then that is not sustainable, right? So yeah, this is, and you are looking at these numbers. You don't look at these numbers again in isolation, like we said in the previous slide. You need to do your ratio analysis. You need to go into the financial statement to understand what the trends have been, whether there's been any anomaly. Typically, I believe the company would have highlighted that why the cost of sales. So if you look at the notes section, so they have, revenue is 23A. So whatever thing that has happened to revenue, the company is definitely going to highlight that in that note section. Same for cost of sales, 24A. So you go into the financial statement and then you try to find out why this is happening, okay? Whether that is sustainable or not, and whether that could have been prevented. If you go to the balance sheet, anybody to tell us what is happening here? What story can you tell from the balance sheet at a quick glance? What is going on? What stands out for you?
Yeah,
Anybody
asset
to give?
has reduced.
Sorry? Israel, go ahead.
Yeah. The asset is reduced.
The asset is reduced,
Our
okay.
asset.
Okay. Okay. Anybody else?
You see, I think we sort of got from their financing expense that's like it has shot from I think 9,000 to 30,000 or something. But then their liabilities here, I don't think, you see, it's like they incurred more or less liabilities than the last year, except like for their long-term liabilities. So it's kind of poses the question of where does the finance cost or financing cost come from if there's not really much liability differences between the 2 years?
That is valid. That is a valid argument, right? Like, where is this finance charge? Are these finance charges, are they probably rolling it over? Maybe they were expenses that they should have incurred in the previous year and they couldn't pay it. So they had to, incur all of that in that specific year. But if you look at, let me bring these things. If you look at loans payable, if you go to the long-term liabilities, one we can see, you see, in 2023, there was no long-term liability, but then in 2024, I think that potentially is the key driver of the finance charges. So they moved from 0 to 7 million, 7.7 million. And that is huge, right?
Yeah.
And the same applies to, the mineral properties as well. Exploration, if you look at exploration, let's start from the asset side. Account receivable is gone down from 14K to 9.4. 9.4. So yes, that is actually positive to cash flows because it means that the company is collecting the cash. It's collecting cash from its customers. Inventory 83, gone down from 83 to 72, which is also positive, meaning the company is actually using its inventory to engage in a productive activity, right? So it's converting its inventory, to cash. So anytime there's a reduction in your current operating assets, it's actually positive to cash flow. But if you look at mining properties, the mineral properties and exploration, the mineral properties have been fairly stable, 397 to 346. But exploration and evaluation of assets, 12K to 27K, to find out, okay, what is going on here, right? Maybe they've identified new sites that they believe, it could help them get more gold, right? So these are all of the things some of the things that will stand out immediately without even doing any further analysis, right? So that is where you go into the ratio analysis is going to help you. It's going to come in to help you uncover some of these things. Now let's go to the cash flow statement. For the sake of time, what story can you tell from Santiago's cash flow statement? Now look at something interesting. When we go back into the income statement, right? If you go back to the income statement, they were making a loss. But if you come to the cash flow statement, they're telling us that the cash flow from operating activities it's gone down, but it's still positive, right? 246K is gone down from 246 million to 65 million. As an investor, this could be concerning. But the key question is, okay, how is it possible that you are generating a loss of 188 million in 2023 if you look at the top line of the cash flow? Generating a loss of 188 in 2023, generated a loss of 144 million, but then you have a positive cash flow coming out. Positive cash flow from operations. So as an investor or as an analyst, what can you say from this? Or what are some of the questions you'll be asking yourself? Because everyone is expecting the company to generate profit. And then, you generate good profit, you make your adjustments, you add back your non-cash charges, and then you find out how much of your operations, your operations from, your core operations positively impact your cash flow. But in this case, there's been a significant loss, but some way, somehow, the company has made adjustments and they're telling us that they have, positive cash flow. Anybody to give this a shot? Okay. So without doing any further analysis, if you look at this, the first thing that stands out is, when you go into your cash flow statement, the company always does add backs. So you see, there's been depreciation, depletion, which is obviously what you expect. So they've added back depreciation, which are non-cash charges. So all of the adjustment that has gone on here, adding back things so adjustment basically means that these are being added back because they were deducted from the income statement, even though they did not represent, actual cash outflow, right? So they've done all of this and they've arrived at a positive number. So as an analyst, your question is going to be, well, if you were generating a loss, but then you are generating positive cash flow, is this positive cash flow you are generating, right? Is this coming from your core operations? Like, is it coming from your core operation? If the company is generating positive cash flow because it is adding back depreciation. And don't forget, this is an asset-heavy business, meaning they use a lot of heavy equipment, so therefore the depreciation is going to be a lot more. So if the cash flow is coming, the cash flow is becoming positive because you are adding back depreciation. And it's not coming from your core operation. It's not because you are selling more gold, right? It is not because you are selling more gold. Is this what you want to see as an analyst or as an investor? So your question is, okay, I actually prefer if the cash flow from operations is growing based on the company's core operations rather than one-off items and non-cash expenses, right? So this is why the cash flow is so important, that you don't look at the income statement in isolation and then think, okay, well, because the company grew its revenue from this to that, yes, then you get excited. The cash flow ties everything together. And then you can understand, okay, what sort of adjustment is the company making, which potentially is making its cash flow look positive. Is that sustainable? Is that coming from the company's core operations? Because if it is not coming from the company's core operations, then it is not sustainable. You also see purchase of plant and equipment. Yeah, obviously, I look at it's actually gone down from 98K to 63K. So potentially, have they sold any of their fixed assets, right? Because ideally, you want to see, for a company that has a lot of heavy equipment, you want to see some form of, how do you call it, investment over time, company growing its, asset base over time, rather than maybe they were selling it because they were trying to sell non-core assets, right? Which is why their PP&E has also gone down. So again, this is just, like an icebreaker where when you start your analysis, do not look at the income statement in isolation and combine everything all the three statements to help you tell a story, what is actually going on. And I'm sure you know what ratios analysis is going to help you do that. So what the most important aspect of the cash flow is the cash flow statement is the company's free cash flow and how much of that it is generating. If you look at the free cash flow, right? Now you take a look at this. The company says it's generating operating cash flow 65K, even though we knew the company started with a loss, right? That is why the free cash flow is always going to expose you. Like, yeah, the cash flow statement is going to expose the company if the company is, trying to outsmart investors. So back of the envelope calculation, if you want to find out what a free cash flow looks like from the cash flow statement, is always equal to your operating cash flow from plus your capital expenditure. And your cash flow is basically the discretionary cash you have, right? After you've catered for your core operations, and then you've also invested in the business, which is why you add the capital expenditure to your cash flow from operations. So the companies, let's take a look at 2024. So the free cash flow is going to be 65 million, right? Plus capital expenditure. So we are going to say purchase of property, plant, and equipment is 63, and then expenditure on mineral properties also 42. If we are adding only these two items, 63 million plus 42 million, to this cash flow from operations, is it positive or negative? Does the free cash flow become positive or negative if we combine these three items? Cash flow from operations, which is 65, minus 63, minus 42, is negative.
Negative.
Exactly. So you see the company is telling us that they made 65 million in operating cash flow, but the free cash flow is telling us otherwise, because as soon as you add investment, there's nothing left for investors. So there's no free cash flow. The free cash flow is negative, and that is very concerning for investors. And if this is a very developed market, like, the market is super developed, the market is actually going to respond in a very negative way. So the key question is, okay, is this a one-off item, right? Is this a one-off occurrence? So if you look at 2023, well, the cash flow from operations came to 247.46. If you add 98 million and 119, I believe, it's probably almost very small amount of free cash flow. So if historically the free cash flow has been negative, then that is very, very concerning. Okay. But then if historically, maybe there were times where the free cash flow was positive, but then there's only one particular year that the cash flow was negative, but then the company picked up, the free cash flow rebounded, then that is not concerning, right? Which is why you don't look at just one specific year. You look at how the company has performed over time, right? Trends are always important, not one specific year. Trends are always important. We'll get to that level in a bit. So this is just, again, like a teaser as you start your analysis of Ashanti Gold. These are some of the things you need to be paying attention to. Your free cash flow, which is the basis of how you value your company with a DCF, it's very, very important. Your free cash flow to the firm is definitely, the estimate is going to be different, but this is just, trying to estimate what the free cash flow position would look like from the cash flow statement. So now that you have all of these, ratio analysis is what can actually help you tell a more comprehensive story about the company. So you look at the income statement, you look at the cash flow, you look at the balance sheet, and now you need to put all of this into ratio analysis to tell a story. The story has to be over time, and how does that compare to the industry? How does that compare to the industry, the company's peers, right? So, and this, again, these are very, very basic metrics that a lot of that, go onto Investopedia, go onto the internet, try and look at specific metrics that you think can help you tell a more comprehensive story. So you start with a growth metric, for instance, which is what you want to look at: total revenue growth. How has revenue grown over time? How has that grown over the last 3 years, right? What are some of the anomalies? Are there any outliers? Were there any specific years that, revenue grew by a significant amount? And what was the driver of this, right? Is that sustainable? Okay. The opposite is also true. If there was a specific year that the revenue declined by a significant amount, was that you think that is a one-off issue, right? or that is also concerning over time. Was that a demand problem? Was that a market-wide phenomenon, right? So your total revenue growth is basically how much revenue, growth the company is able to achieve over time. Your EBITDA growth, which is the EBITDA, is your earnings before interest, tax, depreciation, and amortization. That is basically tracking the company's ability to generate cash flow, and EBITDA is proxy for a company's cash flow. So I'm sure the previous presenter has already gone through this, but again, just touch on this briefly. Your EBITDA is the company's core operations, right? And it tracks the company's core operations regardless of how much interest the company is paying in debt, regardless of how much taxes it's paying, and regardless of D&A, because D&A, it's a non-cash expense. So it's added back to EBITDA to track the company's, to EBIT, to track the company's core operations from its business. So investors care so much about EBITDA because it tells you how much the company is making, how much cash the company is making from its core operations, right? And the reason why you add back interest, tax, depreciation is because interest, for instance, when a company goes to raise debt, that is not a core operation, right? Asante Gold is not involved in raising debt, right? It's not a company that raises debt. It's a company that is engaged in mining, right? So mining is a company's core operation. So the interest expense that the company pays on its debt is not a core operations. Taxes are not core operations, right? If you are paying taxes to the government, is your social responsibility. The taxes do not drive your core operations, right? You don't say because the company is paying 25% in taxes, so the revenue is going to decline. You see where the tax even appears on the income statement. It has nothing to do with how much revenue the company is going to get, okay? And D&A is also a non-cash expense. It's deducted from the income statement, even though it doesn't involve an actual outflow of cash, which is why it's added back. So the EBITDA tracks your actual cash flow that a company is generating, regardless of what interest, tax, depreciation, and amortization. Very, very important metric, especially for a company like this that is asset heavy. Investors, there are a lot of people who argue that the EBIT instead of EBITDA is a key. It's, how do you call it? It's a useful metric, or it's preferred over EBITDA. But EBITDA is generally, widely, accepted across board because it's capital structure neutral. And then it's very comparable. When I say capital structure neutral, it does not care about your capital structure, which is why interest expense is added, right? So EBITDA does not reflect, it's a capital structure neutral metric, which does not reflect the impact of, your finances, and doesn't care about the taxes you pay. Net profit growth, basically how much net profit is growing, how much of a net profit is growing over time. And we saw in the income statement that net profit has actually been negative. So as an investor, as an analyst, what do you think? Is this going to be the case for the next 5 years? What is going to happen for the company to start generating profit? CapEx intensity, which is basically CapEx, capital expenditure over revenue, is basically how much of the company's revenue, how much revenue the company is spending on its growth initiatives, right? So typically a higher ratio means that the company is spending a lot of significant amount of its revenue in capital expenditure, and the opposite is different. And don't forget that all of these ratios, you never look, we're going to get there. You never look at these ratios in isolation. You always want to look at it over time, over the last 5 years. You also want to look at it, compare that to the industry, the peers over the last 5 years, and that helps you to tell a story. For instance, this negative net profit that the company is generating, net profit, and it's not only Asante Gold, so it's an industry-wide phenomenon, right? But if you don't look at how much, what is going on in the industry in terms of peers, you will not be able to capture that. Profitability metrics, gross margin, your EBITDA margin, your EBIT margin, your NOPAT margin, which is basically net operating profit after tax. Again, like I said, these are very, very basic metrics. You need to go out there, do your research, and come up with any of the metrics that you think are specific and are relevant to your story. Gross margin is basically how much for every dollar of sale that the company generates, how much of that goes into gross profit. And the same way, EBITDA margin, for every dollar of sale that a company generates, how much of that goes into EBITDA, which is how much of that goes into cash flow. The same applies to EBIT and NOPAT. So obviously a higher margin is preferred because a higher margin is an indication that the company is managing its cost, right? From the previous slide, the margins were very negative. The company is generating negative margins because it is incurring so much expenses in its operations. So as an analyst, you need to go find out what is the driving force behind this. Why is the company spending so much in expenses, and how does this compare again to the company's history over the last 5 years, and how does this compare to the company's industry? Return metrics, through some of the three basic metrics: return on asset, basically how much it basically tries the company's ability to generate profit from its total assets. That is the return on asset. Your return on equity basically also tracks the company's ability to generate profit with its shareholders' equity. And the return on capital employed tracks the company's ability to generate profit with its capital employed. So the first return on the metric is asset. You're tracking how much of that, the asset you're employing helps to generate return. Second is basically equity. Return on capital employed is all the capital that you have employed in the business. So basically everything that has to do with equity and debt. Obviously, a higher ratio is always preferred. But for instance, if you calculate the return on equity or asset for Asante Gold and it's 20, maybe 10%, nobody cares that it's 10%. The 10% doesn't tell us anything if it's for 2024 or 2023. What we want to know is how has this evolved or changed over time? What has been the trend? And how does this compare to the industry or to its peers? If the return on asset is 10% for Asante Gold, and despite all of this, the difficulty trying to generate profit, but then the industry average is 5%, then we can say that Asante Gold is actually being efficient because it's generating more profit, or it's generating more profit relative to its peers because it's using its assets efficiently. But given that net income is negative, return on asset is definitely going to be negative. Return on equity is also definitely going to be negative. Return on the capital employed is also going to be negative. So you have a real issue. Convince investors why we should invest in this company if all of these return metrics are in the negative territories, right? So you need to come up with a compelling story. And then your credit metrics, which is basically tracking the company's leverage position, how much debt the company is employing, right, to its business. So some of the key metrics you look at is your net debt to EBITDA. Your net debt is basically your total debt minus cash. Again, all the formulas for this are online. Investopedia, just go look for them. This is just, give you like a teaser as you go ahead and start this analysis on Asante Gold. Your net debt to EBITDA, your interest coverage ratio, which is basically how much of your EBITDA, which is your cash flow, how much of that can you use to pay your interest expense, right? So I guess we all agree that we are very uncertain if this ratio is going to be look positive for Asante Gold because it's generated so much interest expense in 2024, and given that your earnings are negative, you probably don't have even any cash flows left to cover the interest payments on the debt that you've gone to borrow, right? So how does this impact the company's valuation? Because if you are not able to pay your debt, don't forget that it impacts your valuation significantly because now you are not able to generate any cash flows to cover your interest payments. And even if you want to go even a step further to understand, okay, how much of that, if you strip out capex, capital expenditure, and you take out capital expenditure from EBITDA, how much is left? And this is a very asset-heavy business. So if the company is even struggling to generate EBITDA and you take out capex, which is this formula, EBITDA minus capex over interest expense, then that even becomes more challenging for the company to the ability of the company to service its debt obligation. You also have total debt to EBITDA. So all of these metrics, you need to find out is a higher amount preferred or a lower amount preferred. Total debt to total capital. Total debt to total capital, obviously a lower ratio indicates that the company is highly leveraged or the company's financial risk is probably elevated. With EBITDA, interest expense, a higher ratio is preferred because that means that you have a high amount of EBITDA, you're generating enough cash flows to cover your interest payments. And net debt to EBITDA is also is also similar. If if this ratio is higher, it means that you are generating your debt position is too high relative to the cash flow that you are generating. So to tie everything together, don't conduct ratio analysis in isolation. Like I said, always compare them to the company's own history, peers, industry average, and uncover reasons behind outliers. Okay. Focus on trends over time. The numbers alone, like we saw in the financial statement, show what is happening. Your analysis explains why. Okay. If you look at the numbers in isolation, you will only find out, okay, this is what is happening. But your analysis behind it explains why. And you need to go in depth, tell us what is going on, why this is happening, and whether you think this is going to improve. If it's not going to improve, why do you think so? All right. And again, it's based on your reading the financial statements, reading the industry research reports on the company, the presentations, management presentation. That is going to help you come up with some of the analysis behind what is going on in the company. So this is just, a high level overview. I didn't want to include the formulas here because everything is available online. If you're not sure, just Google it, go to Investopedia. And I had, Damodaran is also a very great resource, like, the previous presenter mentioned. He's a strong authority when it comes to valuation. So most of the formulas, ask for Damodaran, you find them there on his website. And yeah, I just want to end with some of the industry specific metrics. I don't know if you've covered this, but valuation, you want to value companies based on the company's core operation. So sometimes it's good to understand some industry specific metrics. If you look at a bank, valuation of a bank is completely different from how you value a traditional company, right? So it's important to understand some basic industry specific metrics as well. You have a strip ratio, which is basically equal to your waste mined in tons over ore mined. And this actually measures the amount of waste material mined related to ore. A lower ratio. A lower ratio is preferable because a lower ratio means that you are becoming more efficient. Sometimes some of these metrics, you can estimate that if you have the numbers from the company's annual report, then you can estimate it. But if you don't, you might not be able, because sometimes the companies don't disclose these things. You have your grade. Your grade is equal to your metal content in ore over waste mine, and that basically indicates the concentration of valuable materials in the ore. Because when you mine, sometimes when these companies mine, they come up with all of these minerals, but then it's full of waste. Okay, so this ratio actually tells or indicates whether whatever minerals they've been able to discover is more valuable. All right, and these are some of the things that investors track. And I don't know if Asantigo discloses some of these metrics. So you have to look out for that. Reserves replacement ratio, which also indicates the sustainability of operations by comparing new reserves to depletion. And then it's basically new reserves added over your annual production. And reserve life, basically estimate the number of years remaining for a mine's reserves at current production levels. A higher ratio is preferred because it indicates that it basically tracks your cash flow a mine's cash flow generating potential, right? If you have a 10-year reserve life, if they've discovered a new mine and they say, okay, the reserve life is estimated to be less than 10 years, then obviously you know that for the next 10 years, there is visibility into the cash flows that is going to come out from that particular mine versus a mine that is only going to last for a year or two. Then what that means is that after a year or two, the company would have to sort of, discover a new sort of mine, because it's in the business of mining. So you always want to be in a position where your reserve life is significant enough where it gives investors visibility into your cash flow generation potential. So I think I've spoken so much, right? It brings me to the end of the presentation. I think so. Yeah. So thanks again for joining. Let me know if you have any questions. Yeah, for those that have not spoken, I'd love to hear from you if you have any questions. If you've already spoken, you can go ahead and let me know if you have any final thoughts. I think someone is asking if I can share my slides. Ifie, is this? I mean, I think you. I think that it's being recorded, right?
Yes, it's being recorded. And because of the volume of information for this particular session, we will create I would send them an email on Monday with all the information that was shared today with the slides and then the video recording.
Okay.
So yes.
Okay. Okay. Yeah, so I think the session has been recorded, so you definitely have that afterwards. Any questions? You can drop them in the chat box. If you how are we doing on time?
Yes, we are good actually.
Okay.
Well, yes. So question now, and then we can have the announcements, and Nana gives the final word, and we are done here. So please, if you have any questions, this is the time to let us have them, and then we can wrap up today's session.
Are you guys ready to start your analysis of Asante Gold?
I would like to. Hello.
Yes, Israel, do you have anything? I can hear you.
Yes.
Go ahead.
Yes, I would like to ask how many years are we supposed to move backwards in terms of comparing?
Can you increase your volume a little bit? I don't know if it's because of your speaker, because I struggle to hear you anytime you're talking. So
Okay, I think I would like to type it then. I'll type it.
no, go ahead. No, don't worry. Just go ahead and speak.
I want to ask, in order to make our research efficient, how many years are we supposed to compare with? Should it be like 2 years, probably current year and previous year, or 3 years backwards?
Yeah,
just wanted to know.
yeah, I think typically, 5 years is, it's okay. 3 to 5 years is okay. 5 years gives you enough, story, or it's enough. It gives you enough time to understand the trends that has happened over time versus 3 or 2, right? 10 years probably too much, but I think 5 years is generally average. It's good, and I think it depends on the availability of data. Sometimes the company, especially if it's a new company, you might struggle to get data as far back as 5 years ago. But I think Asante Good has probably been trading, publicly traded for a while. I'm not sure, but if you have up to in the last 5 years, definitely a good way to start, so that you can track how the company has performed over time with all the ratio analysis that you conduct, and any anomalies, any outliers, then you can understand. You can try and dig deeper to understand what actually happened at a specific point in time. So I think 5 years is really is a good starting point.
Thank you, sir.
Any questions? If you don't want to talk, you can drop it in the chat as well. If you are shy, you can drop it in the chat. Guys, okay, I'm going to cold call this. Yeah, I'm going to call. Let me see, what are your names? I have 22 people on the call. Okay. Aaron Ajayi, are you there?
Yeah, I'm here.
Yeah. Do you have what's going on in your mind? Guys, get ready to be cold call until Ifeanyi tells me we are.
So this has been very insightful.
Yep.
In our evaluations, we're about to start evaluations initially. So with this newfound information, like you were saying, we'll try and make sure that we don't do it in isolation. Try and tell a story of what the evaluation is happening as well, to get a fair idea of the company, to be able to get a better position when we evaluate. So I'm from Ashesi too, so just by the way.
Okay, yeah, thanks for that. Albert, Albert, is this Smoldes? Sorry if I, got it wrong. Hello, Albert. Albert, can you hear me? Okay. Benedict Alomo. If these people, are they've not eaten, eh?
It just reminds me of having COVID lectures.
Yeah.
Yeah. So
Emanuela Mensah.
Hello.
Yes.
The session has been really impactful and educative, but actually, I don't have any questions. I think that I've actually understood everything. Yeah.
Yeah, what's your affiliation school?
Yeah, I'm a student of University of Ghana.
Okay. All right. Now let me go to the bottom. Vanessa Mensah.
Hello, I'm
Yep.
a student of KNUST, and this session has generally been very, very informative, especially the parts where you took us through some of the industry-specific ratios which relate to mining companies. And I think it will help us, and we are going to work with that as well. But as at now, I do not have any questions also. Thank you very much.
Okay. Etonam. Well, the ladies are actually, the ladies are doing very well because, they talk when I call them, but the guys are hiding. Etonam.
Hello,
Oh, Etonam.
can you
Okay,
hear me?
okay. Wow, they take us away.
Okay, it's been a very insightful session. I really learned a lot, and I'm sure if we didn't have this session, there will be a lot we personally would have overlooked, but people have brought it to our attention. So thank you.
Okay. I need questions, guys. Blessed Okono. Blessed Okono or blessed, right?
Yeah. So
Yeah, man.
okay. So with the ratios,
Your name and affiliation, and
okay,
yeah.
sorry. I'm Blaise O'Connor from
Yep.
KNUST.
Yes. Okay, nice, cool. Yep.
Yes. So with the ratios, with things like calculating their reserves and stuff, where do you suggest we obtain the info from? I
Yeah.
look through
So
their financial statements and
so the industry specific metrics, which I just shared just a few of them. They're specific to mining companies are quite a number. And even when it comes to valuation, I don't know if the other presenter highlighted that it's also very there are also industry specific valuation metrics for mining companies. But these metrics, it has to be full disclosure from the company. So you need to go to the financial statements, especially the annual financial statement, to see if the company actually discloses this numbers, because you cannot estimate it if the company doesn't disclose it. But if the company doesn't disclose it, then you probably know you're in that instance you're limited, right? There's very little you can do with that. Hopefully they disclose it, and then it can give you more context into what is going on in terms of its mining operations. Because the metrics, the ratios we covered earlier, the growth metrics, profitability, whatnot, those are very general. Cuts across industries, maybe with exception of financials, but then most of them even are also quite useful when it comes to financial company analysis. But yeah, again, everything has to be the annual reports of the companies. Was that helpful?
yes, please. Thank you.
I think Gifty Kali Padu. sure you guys are going to hate me for cold calling you, right? Yeah, I mean, that's what happens even when I go to lectures. So if you don't come prepared, they're going to cold call you and then you have to talk in front of hundreds of people. Gifty, are you there? Okay. All right, Ify, I guess maybe you have to take us away with
Yeah.
the next
Thank you.
steps.
Thank
You
you
want me to
so
continue cold calling?
I am sure we want to wrap up by 4:30. And I'm sure
Okay, so we
there
have like 10 minutes more, eh?
just I have some announcements for them. So
Okay, yeah, then that's fine. Yeah. So yeah,
handle that.
you can take us away.
Okay. Michael, first of all, thank you so much for your time and for sharing your expert knowledge with us. It's been wonderful having you since the inception of the Research Challenge, always volunteering for us. We deeply appreciate your time and effort. The teams, I know today has been yeah, today has been a long day. I have just a few announcements for you. The first one is that your industry mentors, the details of that have been already sent to your faculty advisors. So the team leads to reach out to your faculty advisors, your faculty advisors to check their mails for that information, and so you can schedule your meetings with the industry mentors. That's on that note, you're supposed to submit your first drafts of the report to your industry mentors for review. That is not coming to us. That is going directly to your industry mentors for review on the 16th of December, so that he can have a look at it and then give you feedback. And then as you prepare towards your final submission to us on the 17th of January, which would give the graders also enough time to mark them ahead of the finals, which is in February. With the finals, with the final report submission, in my last email to you, there was a non-disclosure page that was sent. That should be the first page when you're submitting the final reports. Kindly note that your school names, nothing about your school name should be mentioned in the reports. It should be just your team names that you send to us, which is unique to everybody. Please do not include anything about your university, whether academic city, UPSH. There should be nothing like that in the reports. Once we review them and we see that we will flag your reports. So, and you may not go on to the next stage. So please be mindful of that. And on Monday, I'll be sharing the Bootcamp pack with you, so which would have the video and then the slides and the other materials that the previous instructors mentioned. So that is that for me. We have an active WhatsApp page. If you have any questions or concerns which you need quickly resolved, please reach out to us there or via mail. And on that note, I would hand over to Nana Riafe for his final words before we say bye-bye. So Nana.
All right, sure. Okay, thank you. And thank you very much, Michael. Thank you very much, Julius. Thank you very much, Emmanuel, for availing, yourself, to take us through, this insightful presentation. It's a weekend nowadays. People don't play with their weekends. So to take time off your busy schedule to be here, empowering us how to, research and write an equity report. We are very much grateful. And to the students, for availing yourself, to this, challenge. Kudos, to you. I always, feel envious of you anytime such sessions, are held. I wish, I'd had, that opportunity, right? I would have been probably, many, many, many miles, ahead compared to where I am now. So the real, hard work obviously is ahead of you, is to put up, quality research. And it's our expectation that given this bootcamp and given all the preparation, you guys, would go through to generate a report, Ghana, this year, would get, really, really, really far. So thank you. Just put in the work, quality work. Your work should, stand, the test of time. If it is presented in any investment banking firm, both locally and then outside, it should speak volume. So that should be your mindset, right? That should be your mindset. Quality, quality work. And we can't wait, to read, your wonderful report that you would, put out. So thank you very much. Enjoy the rest of the weekend and see you, soon. Bye-bye.
Daddy, can you, Daddy, let's play hide it.
Thank you so much and enjoy the rest of your day.